This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
Donald Trump needs a weak dollar.
I don't hear too many bullish cases for China in 2025.
With Lisa Mateo on markets.
The economic calendar jam-packed today.
And Michael Barr with news.
Trump took steps on everything from TikTok to the southern border.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
Good morning, everyone. Tom Keene, Paul Sweeney, Michael Barr, Lisa Mateo. Mateo deep on assignment. Sweeney somewhere west. He's like Jeremiah Johnson out there. He's out in the Rockies with Grizz.
Yes. Steamboat.
He's
speculating.
Is he in Steamboat?
Yes.
There's Grizz out there. Sweeney will be going down. He's not on the bunny slopes. He's like all expert.
Double black.
He'll come down. He'll take a breath. He'll turn to the left, and there'll be Grizz. That's what they said in the movie Jeremiah Johnson. Paul Sweeney, come back safely, please. We say good morning. David Gura pulling a short straw in yesterday. I thought the interview that we did, editorialized, you did, with the comptroller of New York City yesterday was something about what does the left do going forward?
Yeah, what are we going to find out after New York has this Democratic primary for the mayor in June? As
you see, said. I got that wrong.
You got it wrong.
I got it. So
he corrected you quickly.
Landers people are like, this guy's such an amateur.
And great to hear from him too, just on the news of the day. That, of course, being the decision by the Justice Department to do away with the charges that were filed against the current mayor, Eric Adams. So
we'll
great
do more
to have
of
him, very
that.
timely.
French Hill with us today, the Republican from Arkansas with new duties in the majority House, Republican House, without question for politics important. Tina Fordham with us as well. We welcome all of you on your morning commute. CPI at 8:30 is front and center. It's supposed to be a snooze. I don't buy it for a minute. I think it's going to be a big deal. We'll do that at 8:30. Liz Ann Sonders with us around that time. Bloomberg Surveillance this morning. We're brought to you by IBKR, with a percentage of the United States experiencing drought conditions exceed 18%. This on February 18th, 25. At IBKR Forecast Trader, the yes was recently 35%. What's your take? Trade your prediction at ibkr.com/forecast. For those of you on Bloomberg Radio, I am ensconced. I think Dick Raddatz has a chance this time.
Yeah?
Pitchers and catchers. You don't know who Dick Raddatz is,
but
do you?
I see you wearing your Red Sox jacket.
Pitchers and
catchers. It's glimmering in the light of the studio.
It's glimmering. It's what it is.
What's their season shape? I'll ask Michael Barr when he comes.
No, their season is, we don't go there.
Right, the obituary
I just looked up for their walk-up songs, and there's no walk-up songs listed for the Red Sox because they don't know who's going to play on April 10th or whatever. Let's get right to it with futures and -6 from the Interactive Broker Studios. Our Bloomberg Business Flash, John, in for Lisa.
I'll call it mixed ahead of the economic report of the week. As you say, inflation could prove stubborn as a mule. CPI 8:30 Wall Street time. When you strip out all the things that we actually use, economists surveyed by Bloomberg expecting on a month-over-month basis a rise of about 0.3%. Remember, the Fed's target is 2%. CVS Health issuing profit guidance for the year just below Wall Street expectations. But still, what a pop pre-market, up close to 9%. CVS Health. Lyft falling, trading after giving a disappointing outlook for the first quarter gross bookings. They also said that cold weather has hurt demand for ride hails and bike rentals. Biogen reporting better than expected quarterly earnings driven by continued growth in sales of its Alzheimer's drug. Heineken shares surging. The brewer announcing a buyback, also reporting strong beer sales. Burger King's North American business expanding in the fourth quarter. Burger King's parent company, Restaurant Brands International, also posting same-store sales that beat estimates. Right now, the Dow futures down 57, S&P E-mini futures down 6, the NASDAQ futures up 6. Oh yeah, Apple renaming the Gulf of Mexico to Gulf of America on its Maps app. The White House yesterday blocked an Associated Press reporter from the Oval Office because they demanded the news agency alter its style on the Gulf of Mexico. So
my job is not to give an opinion on this, nor
but
Mr.
anyway.
Gura's as well.
He's going
I'm not going to. But David, is this like the president can do this? Can he rename Chapel Hill tomorrow?
Well, he can do it on sort of government documents and things like that. My understanding is that the AP's argument was they're a global news organization. They were going to nod to what the president put in place in that executive order on their U.S. output, but they didn't want to change it globally. They wanted to kind of have both in the parenthetical in other places, and the White House was not satisfied with that.
John, are you done over there?
Yeah, if you want me to be
Did
done.
it snow?
Okay.
Any snow in the wilds of New Jersey?
4 inches,
4 inches.
by the shore. Snow cam shows me it's still kind of coming down.
But you made it in.
I made it in. It was a treacherous ride initially. So, once you got to the Parkway and the Turnpike in New Jersey, the conditions. Yeah, I mean, you pay a lot for those to use those roads, and they do take care of them.
But a morning like today, you would. You doing all right over there, Tom?
Yeah, I'm doing fine. Let's get started. Urian Timmer with us right now with Fidelity. Thrilled that he could be with us. Uri, the only reason we have you in is from my seats at Fenway years ago.
It's the Red Sox theme.
Peter Lynch sat 10 rows down.
Yeah.
Because Magellan was doing better than my bank account. So we started with Fidelity this morning, their commitment to baseball in Boston. And good morning, 92.9 FM.
Good morning.
Urian Timmer with us. David walked into the studio at 6:59, Urian, and the first thing he said is, Urian Timmer on LinkedIn is lights out.
That's very true.
What do you say on LinkedIn now? When you translate it away from the portfolio managers at Fidelity, what is the Urian Timmer equity market message on LinkedIn?
The message is that the last 2 years saw a budding earnings cycle be amplified by a lot of valuation expansion. Now this year, that earnings cycle has really, flourished. I mean, fourth quarter earnings season is still underway. I think we have 330 companies reporting, but the estimated growth rate, which I get right from my Bloomberg terminal every Friday, has jumped from 8% to 13%. And so earnings are strong. The economy is doing well. And but after 2 years of amplification from the valuation side, valuations are rich. I mean, I'm not telling you anything new there. And and at the same time, we have sort of this Fed model lurking in the back where every time the 10-year goes to 4.5 or above, it starts to take the mojo away from the market. And so we have a new sort of dynamic for 2025 where earnings will carry the day. I think the bull market is alive, but you're going to get these occasional wobbles. And as a result, the market kind of churns a little bit. Like if you just look at the last 5-6 weeks, the markets have done well. And January, from the asset classes that I track, everything went up in January, but it doesn't really feel that way. It feels kind of like a churn.
I totally agree. The feel's not there. The 10-year yield right now, 4.54%. It's where Urian Timmer says we churn.
Urian, you say the bull market is still alive. Let's keep with Tom's baseball theme of the morning here, and maybe you can tell us what inning you think we're in this cyclical bull market.
I think we're in about the 7th inning. So the bull market started 28 months ago. The median bull market going back 100 years is 30 months, good for a 90% price gain. We've done about 78% over 28 months. Of course, the median is it's kind of a useless indicator because you have such an extreme range of outcomes where, the one in 95 lasted for a lot longer. But we're getting at that point where, bull markets begin on price because price always leads the fundamentals. The price always anticipates a turn in the fundamentals. It doesn't always anticipate it correctly, but it does always anticipate. And so price bottomed in October 22. Earnings bottomed a year later, third quarter of 2023. And so we had that multiple expansion for a year. And my incorrect forecast a year ago was, okay, earnings are going to carry the baton, which was correct. And then PEs were going to sort of take a backseat, which is typically what happens in year 2 of a bull market. And they didn't do that. They actually still, added 2/3 of the return. But I think it's hard for that to continue. And if you look in history, more mature bull markets tend to get plagued a little bit more by rising rates. Again, the Fed model from the Alan Greenspan days compares the PE on bonds to the PE of stocks, and the PE on bonds is the inverse of the yield. It's trading at about 22 times the coupons that you're getting. That is very competitive with equities, and bonds are supposedly the risk-free asset. So as the risk-free asset competes with the risky asset has to then reprice itself through lower valuations. And I think that is kind of a late innings theme, seventh, eighth inning.
Yeah.
And doesn't mean the bull market is over, but it kind of flattens out a little bit, and you get these sort of tensions that you really didn't see earlier on.
Jurgen, as we look at history, bull market history, what do we know about how it customarily plays out when it comes to breadth? We've talked so much about the narrowness of this market focused on the Magnificent Seven. Are we seeing something unique here in kind of a narrow market expanding in these late innings of this bull market? Is that how it usually plays out?
This has been a very unusual cycle from the breadth perspective, because what normally happens in a new bull market is that it follows typically a recession, or at least a substantial drawdown that tends to hurt the small caps more than the large caps, because the large caps tend to be the quality names. They hold up better. They have better balance sheets. They have more cash. They're less sensitive to what the Fed's doing. And so normally, in a new bull market, those small caps, those kind of junkier stocks at low prices, they really rally out of the gate in a huge way. And then as the bull market matures, they tend to fall away a little bit. And then just these blue chips are left, hanging up there. Obviously, this time we've done nothing like that, right? This bull market started narrow with the Mag 7. That was 2023. If you were not in those names, you were not feeling the joy of a 20% plus bull market.
Right.
Then in 24, it did broaden until the second week of December. And now we're kind of neither here nor there. 52% of stocks are above their 50-day moving average.
Right.
62% are above their 200-day. And you can see a series of bearish divergences as price makes higher highs and breadth makes lower highs.
Jurgen Timmer with us to start strong here on the technical structure of this market. He is with Fidelity, of course, in an extended interview here. Coming up, David Gura in a conversation, really looking forward to this, with French Hill, now with financial services in the House. The gentleman from Arkansas has been such a supporter, and David, it's like a 4-hour conversation where we have to cram in here. Jurgen, I want to go technical right now for Global Wall Street listening. Are the charts that you have of the equity market, and I guess of full faith and credit debt, are they well behaved in that they're drifting on a unit basis and honoring trend? Is there a cadence to the market, a printing of the tape that is normal right now?
That's a deep question, Tom. But I would say the answer is
Jurgen, it's
yes.
pitchers and catchers. Today is a day for deep. If I was interviewing Mr. Lynch, he would understand today is a deep and important. A guy from Dutch Caribbean. Jurgen, do you understand? This is like the day of the Vatican. So, as a deep question, is the market behaving on a drift basis?
Yes, it is. Markets are, especially in the U.S., are extremely deep, liquid, extremely efficient, brutally efficient, I would say. The market's not always right, but it is very efficient in incorporating whatever new information becomes available. And I always say that as a warning to people trying to market time the market, saying that the market's going to adjust much faster than you will in your portfolio. So why even bother? But you look at the overall tape. And, the market's a little bit in limbo, but that kind of makes sense, right? I mean, you look at Bitcoin's been stuck at 100. The S&P equal weighted is below its highs. Breadth is sort of, lackluster. But the markets are waiting, right? The markets always price ahead. So you had the election, the markets ramped up. You look at the sentiment data, you look at flows into equity funds and ETFs. I mean, they're way up there. So the market is positioned for like the Trump trade, for animal spirits, deregulation. The Fed is sort of on board by saying no rate cuts. I think the Fed is done cutting rates at all. Everyone is focused on the long end of the yield curve, as they should be, right? Because the earnings are solid, the Fed is done, but the shape of the curve and the long end are going to be very important because with the whole deficit story, because if the long end goes from 4.5 to 5, the stock market is going to react. Okay. And in that sense, it's being very efficient.
Get one more question in here, because what we want, Abby Johnson has Mrs. Yawkey's old tickets. I mean, it's that cool. Get one more ticket here, and maybe Urian will invite us up to Mrs. Yawkey's old seats.
Urian, set the table for us today with these data that we're going to get, the CPI data that we're going to get, and you say that you think the Fed is done cutting here this year. What are you hoping to hear, if anything, from the Fed chairman today when he speaks before the House Financial Services Committee?
I think he said it all yesterday in front of the Senate and also at the recent FOMC. The Fed gave back 100 basis points in a very Greenspanian type of fashion, because Greenspan did that in 95, right? He raised rates 300 in 94. Nobody saw that coming. I remember it very well. And then he gave back 75, and the soft landing was achieved, and the market took off. And guess what? That's kind of what we've done here. But the Fed's not going to give more than that until inflation really comes closer to its target. And the thing, as a technician that I look at, and Tom knows this, you look at a series and it makes higher highs or lower highs and higher lows or lower lows, and that's how you establish a trend. And, the inflation rate went from 1% pre-COVID to 9% in 2022 and has fallen back to about 3%, more or less. Right. Now, the 5-year average went from 2% to 4% today. For that average to go back down to 2, you need the year-over-year rate to really fall, and it isn't falling anymore. Right. Like, it would have to fall below 2 to get the longer averages down, and it's holding at around 2.8, 3.0 or so. Yeah. And if we get another animal spirits wave in the economy and we go back to 4% inflation, I think the Fed would be very worried, as it should be, because then those longer run averages are running away, and that genie was never put back in the bottle, in the first place. So that, I think, is the concern with inflation, and that's why the Fed is holding its powder dry here.
Urian, thank you so much. We got to go here. Thanks for the morning brief to get us started strong. Urian Timmer on technical analysis, and of course, all that he does across the Fidelity platform. Somebody out on YouTube, thank you. They thought I was a Reds fan. All of America, even Michael Barr, is a Reds fan, because the opening day should properly open on April 10th. Michael, help me here. It's got to open on April 10th. None of this early malarkey.
I agree with you.
And the president goes out to Cincinnati and throws out the first ball.
Yeah, I've seen snow on April 10th in Detroit. So
we have.
Yeah. And so, I mean.
And now we start the stupid March early stuff. And, I don't understand it.
I agree.
The Reds, Terry Francona is going to be there this year, and that's cool. He's a winner. Speaking of winners, with our news in New York City, Michael Barr.
Thank you very much, Tom, David, John. President Trump is ordering federal agencies to work with the Department of Government Efficiency to slash their workforces. Bloomberg's Amy Morris reports from Washington.
The action by President Trump allows federal agencies to hire no more than one employee for every 4 workers leaving the government. Bloomberg News has learned the action is designed to significantly reduce the size of government and limit hiring to essential positions. Elon Musk, in the Oval Office with President Trump, says he's operating transparently.
And you can see, am I doing something that benefits one of my companies or not?
And if we thought that, we would not let him do that if we thought there was a conflict of interest.
It is not clear if DOJ has the authority to enact these mass dismissals. In Washington, Amy Morris, Bloomberg Radio.
Amy, thank you. The cost-cutting measures are sparking a lot of criticism from Congress. Massachusetts Senator Elizabeth Warren talked about it on Bloomberg yesterday.
By letting Elon Musk move in against USAID, he's shutting down the government.
Senator Warren also accused Trump and Musk of sidelining the nation's financial cops by shutting down the Consumer Financial Protection Bureau. Mark Fogel, an American teacher who was deemed wrongfully detained by Russia, has been released and returned to the U.S. The White House described it as a diplomatic thaw that could advance negotiations to end the war in Ukraine. Millions of Americans are facing dangerous weather from coast to coast. In Southern California, communities affected by the recent wildfires are bracing for heavy rain that could trigger mudslides. In the east, back-to-back storms, bringing a mix of snow, ice, and freezing rain. The governor of Virginia declared a state of emergency. In Washington, D.C., snow fell at one point at an inch an hour. In southern New Jersey, up to 6 inches of snow fell. Crews from Iowa to New Hampshire are now clearing the streets as they brace for another storm taking aim at the Northeast and Midwest today. Global news 24 hours a day, whenever you want it, with Bloomberg News Now. I'm Michael Barr. This is Bloomberg. Tom, right. David, and John.
Thanks so much, Michael Barr. David Gura, I want to get out front of this conversation with French Hill. I just think it's too important. And the basic idea is guys like you are focused on the middle of March. And what is it? A potential government shutdown and an overlay of other budget issues?
We're getting close to it and still don't have clarity on sort of what the path forward is for Republicans. So eager to talk to him just about what he's hearing from the Republican caucus in the House. And as you point out, it's weeks away here when we need to have something. And we've seen the House fumble this over and over again. So there's a fear, I think, among many Republicans.
We've been here before, but is this time different?
Well, there's a new president. And there is a new president, and I think that does change the tenor of this one, Tom.
We'll have to see. Was Mr. Musk's son well behaved in the Oval Office? I think
all right.
He was, he's pretty okay.
Stood there and wore a little suit jacket.
It was good.
It was an odd
style. Bloomberg surveillance.
And I'm John Tucker in the Bloomberg News, and with this Bloomberg Business Flash, 8:30 Wall Street time. That's what we're waiting for. We got to look at the January inflation with the release of the Consumer Price Index. When you strip out volatile components like food and energy, economists we talked to think inflation's up 0.3% on a monthly basis. The trading desk at J.P. Morgan Chase Market Intelligence estimates the S&P 500 is going to fall as much as 2% should the CPI show an increase of 0.4% or more from the previous month. Among the earnings we told you about a bunch of them. Let's do Gilead Sciences. Those shares rising pre-market trading. The biopharmaceutical company's 2025 guidance beating analyst estimates. DoorDash, this is after the close, the largest food delivery service in the U.S., issued an outlook for orders in the first quarter that surpassed Wall Street expectations, serving as yet another sign consumer demand does remain resilient. And if I have to cancel my credit card because of DoorDash charges one more time, I'm gonna be upset.
It's unbelievable.
Well, they go into my wallet at night, and it's just like, and then DoorDash has my. It just drives me crazy.
And they knock on the door at 10:45, and
I was leaving for work and got my wits scared out of me because there was this woman standing at the door. I'm like, "What are you?" DoorDash delivery
at 4 a.m.
French fries and like cheeseburgers
and a case of Molson Golden.
Did you keep the meal?
No, it went to one of the youngers.
What have we become?
It's just like crazy. Anyway. Dow futures down 74, Nasdaq futures up 20. 10-year kind of Urian Timmerish at 454, up 1 basis point. And that's your Bloomberg Business Flash.
Thanks so much. Greatly appreciate it. What a joy now. Yelena Sholteva joins us, economist at the conference board here. And Yelena, I think with the blur of news that we have, including French Hill coming up on a government shutdown in the middle of March, let's just cut to something clean and simple. January and CPI. Do you even care what happens at 8:30? Because January is such a mental month of price increases for David Gura and particularly John Tucker.
It's also a pretty steep price increase for me too. So my husband went to Costco last night and he couldn't even get the eggs. So
Not available.
So in terms of inflation in January, it's a tricky month. Yes. So you look at seasonal factors. There's an additional uncertainty about the number, and you just have to basically look at the broad picture. So Chair Powell yesterday said they are on hold, and this is what we expect for them to do, at least in the first half of the year. So whatever inflation does, probably they're going to be less sensitive to a particular number. Okay. But I think the trend is still going to be downwards because the economy is slowing, and this is what the broad picture is telling us.
How are you navigating the uncertainty surrounding tariffs? What has been put in place, what's been postponed for 30 days, what's being researched with the report to come, your sense of the degree to which that's going to weigh on the economy here in the months to come?
How we navigate uncertainty, we run
Eyes
models.
wide open.
Models.
Yeah, sorry.
So, we look at different scenarios. So one scenario that we consider is if we get 10% on China, 25% on Mexico, and 25% on Canada. And that is telling us that GDP growth could slow down to something like 1%, after 4 quarters. So that would mean that growth is so slow that it could be on the verge of slowing down into the negative territory. That's what happens when growth slows down to 1%. That also means that inflation could pick up, and the estimate is something like 0.6 percentage points for inflation. And, that would make things very tricky for the Fed.
Based on what you just said, with slower real GDP, half our audience agrees, half doesn't agree. Good morning, that's what makes surveillance go. I got an Atlanta GDP number just under 3%, 2.94%. Do you observe now growth slowing?
Not right now, and that's a key point. So over the turn of the year, GDP growth has been really strong. Consumers and businesses
I would say for the last
up.
24 months, it's been the great miscall of every economist except for the conference board. Continue.
Totally agree. But this is what's happening right now. You have to look beyond that, and you really have to look at factors that are affecting, growth at this point. So we know that, the labor market is solid, but it may be slowing because there's so much uncertainty. Look at the uncertainty indexes. They're surging through the roof, right? So companies and consumers alike, when there's a lot of uncertainty, they kind of tend to begin acting more cautiously. And this is really a predicament for our forecast.
Off of Jason Furman's blistering essay in Foreign Affairs on the failure of manufacturing investment and this idea you can target and make and create manufacturing jobs, what does the conference board see in corporate investment in America right now? What's the first derivative?
It takes time to really start investing and start believing in what is happening. The policies could be very beneficial for the domestic producers, but it takes time. And still there's a lot of uncertainty. So there's like this tug of war between animal spirits boost and uncertainty drag in the economy right now.
What is your sense of the longevity of the Fed's 2% target in light of how things have played out, how inflation has stalled? Here we have this new administration, policies that may be inherently inflationary. How much longer can this Fed chair and this Fed hold on to that target as we go month by month by month and no changes fundamentally happening?
I just take his words for granted. He says
no
change to that, and I believe it because right now it's about credibility for the Fed, really, and they will try to achieve that 2% target.
Last question here, just about the data that we're going to get this morning. We'll be distracted by the headline number, but what should we be looking for beneath those numbers as we kind of dig through the data after we get in?
I mean, we'll take a look and see how much the seasonal factors affect the number. Is it really a regular January boost, or is it more of a trend? The details will matter. Car prices, I will look at, given the wildfires effect, and other prices, shelter prices as well. So I would be looking at services prices, ex-shelter as well, to see how much inflationary pressures are there in the economy.
Gillian, thank you very much. You good? Yeah. And do you have any more?
No, I think we're fine. I think, Elena, thank you so much.
Thank you, gentlemen.
CPI, it's going to be news at 8:30, right?
Totally.
You don't think it'll be a snooze?
I do not think it'll be a snooze. No. January's nuts.
Yes.
I mean, John, how much did your home insurance go up this year?
Well, it went up significantly, but I had to change companies, so it's now Joe's Insurance Company of South Jersey.
Really working out of a gas station.
And I'm sure if something happens, they'll be right behind me.
I
Joe's
looked
Insurance.
at my envelope and said, do I want to open this? And I'm sorry, it was like an 18% pop. Last time I looked, and I'm waiting for January.
Well, I thought you'd be in the category where you can just forego it.
Yeah, no insurance needed for the Keene household.
Well, we try with they're vicious guard dogs. Elena, thank you so much.
Thank you so much.
This is a joy. French Hill, after decades of service to his constituents in Arkansas, has the worst job in Washington. He has had a House Financial Services Committee, the Republican from Arkansas, and he joins us right now. French, I got 8 ways to go here, but I got to look to the second, third week of March, where the challenge is a government shutdown, budget challenges. You're going to be in the heart of this. So I'm going to go to someone on your committee like Monica de la Cruz, the Latina from Texas. Fine. Okay, the conservative Southerns that don't want to budge on the budget, how are mainstream Republicans like you going to convince them to keep the United States of America running?
Well, Tom, this is such an important question. Great to be with you this morning. This is something we should have done in December, and it was a horrible mistake, in my judgment, not to complete the funding for FY25 in the previous Congress under the Biden administration. We would have had roughly the same characteristics. We would have had an incoming Trump administration, an incoming Senate. I think we would have gotten substantially the same deal. And now we're trying to do budget reconciliation, which is a much more important task, and yet we face, as you point out, a government shutdown. Republicans have to stick together. We should use the Fiscal Responsibility Act numbers from last year and negotiate with the Senate, now a Republican Senate, who wants to spend a little bit more on defense, and get this behind us so that we could go to the main event of focus on reforming regulation, reforming productivity in the federal government, reforming spending, extending pro-growth tax cuts.
Give us your sense of how much optimism you have that's going to happen here. I know there's a lot of nervousness and apprehension that time is running short. There are different views on this. We were spending the last few weeks talking about will it be 1 bill or 2 bill or 3 bills. I know you've been involved in the same game there on the Hill. Do you see a path forward here? How much clarity do you have at this point?
Yeah. Well, first on Tom's question about FY25, finishing FY25 before March 14th, I have medium confidence. The worst case scenario would be to continue a CR till like September 30th. First of all, once you hit April 1st, you'll have a 1% across the board cut in FY25 spending. And CRs are terrible for government management. We'll end up spending billions more because we operate under a CR. We won't be able to start any new programs at the Defense Department, which is a priority for the administration. So that makes me lean to, yes, we'll get something done on March 14th on fiscal 25. As to budget reconciliation, the big game, I do support one bill here in the House because I think that's how we hold the Republican coalition together best here. And as you know, Senator Graham in the Senate's taking a different approach.
Congressman Hill, what is the view from the Longworth House office building of what we're seeing the White House do? Of course, the historical precedent has been that Congress controls the purse, makes decisions about funding, and we are seeing this administration take a more active role, shall we say, in determining what gets funded and what doesn't. How much comfort do you have with ceding some of that power to your friends and colleagues in the other branch, the executive branch of Pennsylvania Avenue?
Well, I think you find on money that's appropriated, Congress does control those purse strings and they direct that spending. But in the broad swaths of federal spending, you have directions to agencies, spend this money on these general topics. And that's what the appropriated money says. And then you have Article 2 authority with a lot of discretion about how to spend it. And I think that's what President Trump's attempting to look at. is the spending done at the end of the Biden administration and proposed to be spent here in the first few weeks of his administration, is it in alignment with his goals that he has in foreign policy, for example, at USAID? And that's a classic Article 2 authority to take a look at that, make sure it's in alignment with their policies. With that said, you can't do these things without both the legislative branch and the executive branch ultimately working together.
Then, French Hill, you and I have known each other since time began, and I've never seen a private citizen in the Oval Office standing there with his arms crossed like he owned the high ground. You are one of the rare beasts that came to Congress actually running a business in Little Rock. What's your advice to your fellow moderate brethren of the Democratic and Republican persuasion? What do they need to do in the coming days?
Well, first, let's look at DOGE, Tom. It's a good idea to go in and look for efficiency in government in the executive branch and make recommendations to the legislative branch when you want to spend money differently or have a different number of full-time equivalent positions in an agency. That's perfectly a good suggestion. And we haven't done it in years. I'd say since 9/11, the government's been focused on growing, not remotely focused on productivity or realigning or investing in technology or doing anything in a different way. We've been completely distracted by the war on terrorism, the 2008 crisis, and then the recovery from that, and then the pandemic. So I think it's overtime to scrape the barnacles from the ship of state when it comes to regulatory policy, personnel policy. But there's a right way and a wrong way to do it, and I would encourage the administration to plan, communicate, and consult with Congress on how the best way to do that is.
As for the right way to do it, I think of you as a young man serving as a Deputy Assistant Secretary in the Treasury Department under Nicholas Brady, and I wonder if you could have imagined you would have non-appointed, non-confirmed private sector individuals going in and looking at the payment system there in the Treasury Department. Does that make you uncomfortable, having the history that you have with the Treasury Department, to see the way that DOGE has been approaching the sort of fiscal health, the books, for lack of a better word, of the federal government?
Well, when I heard about that story over the weekend last week, I called Secretary Bessent. We talked about it last Monday, and he assured me that anything that DOGE was doing was in the control of the official Treasury Department, and that some people were working there for IT review purposes. But he implied to me that he's got that under control for making those recommendations. We're going to hold him accountable. He's the Treasury Secretary. So anything that DOGE is doing in a cabinet agency, we just need to remind the American people, members of Congress, the Trump administration, we're holding the cabinet secretary accountable for, as I say, planning efficiency changes, budget changes, personnel changes. We're holding them accountable here in Congress.
We got some news overnight that Jonathan McKernan, formerly the FDIC, has been picked to head the CFPB, and this has been an agency that's been in the crosshairs. I think it's safe to say you've had your criticisms with that agency over these last few years. And I want to ask you about some comments that the gentlelady from Cambridge, Massachusetts made on our air last night, the senior senator from Massachusetts, Elizabeth Warren. And she said, look, it's not up to the executive branch to decide whether or not an agency like the CFPB exists or what form it takes. That's up to Congress. And the point that she's making is, you and other lawmakers, if you don't like what this bureau, this agency is doing, you could take action yourselves. Lawmakers could decide whether or not it should continue to exist. Do you agree with the argument that she's making there, that fundamentally it's not up to the executive branch, not up to this administration to decide what agencies, what parts of this government should stick around or be disappeared?
Well, as a general matter, you'd have to look at statute by statute, agent by agency by that. But as a general statement, sure. I mean, Congress creates agencies. Congress can end agencies. There's nothing so permanent, though, as a temporary government program, as President Reagan reminded us. But let's talk about Elizabeth Warren. She's the founding mother of the CFPB. She created it to be insulated from oversight, insulated from appropriations, and insulated from any meddling by Congress. And that's what's irritated Congress, and that's why I support changing the agency dramatically.
But French Hill, I got a couple final questions. This is important, as you mentioned, the senator from the Commonwealth. Where do we find a middle ground? You are one of the leaders of the middle ground in Washington. How does Senator Warren and someone over on the MAGA right find a common feature around people like French Hill?
Well, it's a great question, and I've urged Senator Warren to consider that exactly. She's concerned about the big banks taking over the world. Well, she's created that with Dodd-Frank. It concentrates more power into those big banks. I've encouraged her to consider tailoring policies for all the rest of the banking system, and also considering compromise on the CFPB by putting it under congressional appropriations and having a bipartisan commission that oversees its work. Those are middle ground points.
French, I don't care. Here's what I care about. My father worshipped Bill Dickey of Little Rock, Arkansas, the ex-Yankees, million years ago. Your minor league ball team, the Arkansas Travelers, Texas League, they play in the Dickey Stadium. How's the state of minor league baseball in Little Rock as we have pitchers and catchers today?
Boy, strong. There's no better place to be on an early summer night. The price is right, the fun is great, and it's fun to beat the teams in the Texas League, and it's something I love doing with not only my family, but all my friends.
There were the Seattle Mariners. You think I could see the Red Sox, down in Arkansas.
We got to make every time I fill in on this show, we have like 3 trips we need to take on the heels of each show.
We do that.
Little Rockers in baseball sounds like a good plan to me.
We'll put you right behind home plate.
Oh, I love
French
that.
Hill, in honor of the beloved Barney Frank, I hope you do as well as Barney Frank. He's head of the Financial Services Committee in Washington, the Republican from Little Rock, French Hill, joining us. We welcome all of you here. A lot of commercial-free interruption. We love to do that to bring you a better conversation on your commute across America. Good morning, 99.1 Washington, taking notes on French Hill. We'll do much more of that. David Gura, of course, doing that each and every day on the Big Take. This sort of floated up here, and you say, wow, there's some resuming here. Leslie Paulty-Guzman joins us right now. David, why don't you bring in Leslie, our fellow at the Center on Global Energy Policy, about the marginal price of gasoline.
Leslie, great to have you with us. We haven't talked a lot about energy in recent days, and we had our colleague Alex Steele talking to Secretary Chris Wright yesterday. We'll get to that in just a minute, but I'm curious, sort of beyond the headline of drill, baby, drill, what you see as the fundamental change to this administration's energy policy is just 4 weeks into their tenure.
Good morning. Thanks for having me. So I think the headlines, pro-fossil energies is correct, but it's also going to be all the above energies. So yes, liquid gold, made in America, oil and gas, but we're also going to have geothermal, nuclear, renewables. The energy transitions, it's out of the box. And so I think he understands that all the energies need to coexist because this is going to happen for a couple of years.
At the AI conference in Paris, thank you, Tom McKenzie, for a brilliant effort over there with Mr. Altman the other day. Leslie, the leader of France, stood up and said, we had the courage to continue to do nuclear energy when everybody else walked away from it. This is a key question. Do you see, given AI, and need for power, a shift back here, a seismic shift back to the building of atomic energy?
Yes, I think we're going to see a revival of nuclear energy, but it takes time. At least a decade for new plants, even if it's smaller nuclear plants, it's still a long process. So in the meantime, we're going to still need natural gas, the renewables and other energies. I think nuclear revival is happening, and I think the French were pointing a finger to the German, who have decided very hastily to leave, phase out nuclear.
Tom, Leslie came in and asked if she had to put on headphones. I said no. I'm going to ask you to put them on only because our colleague Alex Steele, as I mentioned.
It's a well-oiled
Sorry, I should have thought it. She sat down with Secretary Chris Wright yesterday, and something that they talked about was the prospects for more investment in liquefied natural gas. Here's what he had to say when she asked about that.
I think it could grow meaningfully. It's probably not going to grow meaningfully in the short run, although our natural gas production, I think, is going to grow dramatically in the next 2 or 3 years. But if you look at 5 or 10 years, could America grow our oil production significantly? Absolutely.
So he's talking about natural gas. He was talking about drilling for more oil. Take the headphones off now. I'm curious,
Can I take the headphones off?
You can't, Tom.
Okay.
The economics of this, again, so the siren call here is drill, baby, drill, but there's a point at which that becomes economically not cost-effective for us to do here in the U.S.
So the U.S. is the largest, I think now, producer of oil and gas globally, and for LNG exports, the largest exporter. it makes a lot of sense for the US to use this competitive advantage. You can even talk about an absolute competitive advantage. It's the envy of the world. It wouldn't make sense to abort this revolution, too early. And I think this administration understands that, yes, they will unleash this power, but all the different energies at the same time.
We've talked a lot about the prospect for tariffs. Of course, we're in this interregnum now where the White House has said we're not going to levy these additional tariffs on Canada for 30 days. I think we have 25, 26 days left in that period. What does it mean for energy prices broadly, the energy relationship, if those tariffs were to go into place with Canada?
So actually there is, bilateral trade on energy between the US and Canada. Trade wars are happening because this is a strategy from the new administration to open up negotiations. It's an area of unpredictability in this case, but I don't see them lasting. I think it creates a lot of volatility in the short term, but I don't see them lasting.
Amid the swirl of headlines about that and Greenland, there are also the headlines about the Panama Canal, and I wonder how vital that is for the energy market, the use of that and sort of, whoever controls it, how important it is to the energy market.
Yeah. So actually on the commodity and maritime side of things, I think it makes a lot of sense to put pressure on Panama. Why? Because if you want to export all this liquid gold from the US to Asia, and especially Northeast Asia, this is a shorter route. And Panama has been sitting on the study for more than 6 years. They knew they had to invest more in a new water project to bring more water level for the Panama because there has been drought and other issues.
Right.
And they have not done anything. But in, I think, early January, they announced that they will invest in this water project.
Did you bring this up at Tufts when you were there?
Oh.
I mean, how many professors fell off the chair? What are you proposing? Well, I only got a minute left. We're going to have you back on this. Are you proposing that we de-Carterize our agreement with Panama?
No, but I think a good relationship where Panama is pushing the interests of everybody. They made a lot of money with the auctions and putting, whoever tanker was paying the most first. They had no interest in changing things around because actually they made more money with those auctions than by...
You would do away with the bidding of which boat goes through first.
Well, I think they need to change around the system and bring more water and make investments where it's needed.
Refurbish it. Make it more efficient.
They need a new dam project.
A new dam project.
I remember the uproar over Panama in the 70s with Jimmy Carter.
When the deal was signed.
Huge uproar, both ways.
Yeah, and the whole geopolitical situation, with China, if things happen, you need to move naval and, military boat quick. I think it comes into play.
Thank you for being with us, Leslie Peltier-Guzman.
Thank you.
Great to have you here today, Center on Global Energy Policy. Love notes from Panama, no doubt you're going to get there. That's interesting, really, really interesting. David Gura and Tom Keene, we're 45 minutes away from a CPI report. I refuse to believe it's a snooze fest. My radar's up here this morning. I got red and green on the screen, NASDAQ giving me a little bit of love. But, David, it's range-bound. I mean, the whole thing is a snooze while you've been here for 3 days.
Well, we've had no shortage of headlines. But, yeah, when it comes to the economic data.
Right. I want to give you an example. I got 10 seconds to do this. This is how we do this. I'm waiting for an essay on AI and debt of Mag 7. It just came across the transom here. Robert Schiffman of BI with the first definitive essay on this, and we will get Robert Schiffman on to talk about all that money they need for AI and where's it going to come from? Debt. Good morning.
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney on Bloomberg Radio.
Good morning, everyone. David Gura in for Paul Sweeney. Thrilled you're with us today. As David just mentioned, Liz Ann Sonders will be with us back-to-back with Gina Martin Adams on the stock market. We'll do that here in a moment. Bloomberg Surveillance this morning is brought to you by IBKR. Will the U.S. CPI, will it exceed 2.4% in March of 2025? Trade your prediction with IBKR Forecast Trader. The yes, it was recently at 60%. 60% by yes or no, and earn $1 if you're right. Go to ibkr.com/forecast, and helping you with that will be the CPI report. We'll do some good work on that here in about 35 minutes. Joining us now in the storms in the corridor from 99.1 FM in Washington up to 92.9 FM in Boston and inland is the only weather guy on the planet who enjoyed the Long Island Express, the 1938 New England hurricane. Craig Allen joins us now, Bloomberg meteorologist. Okay, I know it's not 1938, but come on, Craig. Right. It's just partially February, right?
I'm just upset that you now think that I look like I was back in 1938 enjoying that storm. No, I'm only. We have several storms, not just one big one. We had one over the weekend. We had one last night. We're going to have another one tonight that goes from the D.C. corridor right on up across Long Island into Boston. Right. And we're going to have another one over the weekend, and we may have another one in the early part of next week. So it's like one after the other after the other. It just keeps on coming from the West Coast all the way to the East Coast.
Craig, within the storms that are coming in tonight's commute and tomorrow's commute, where is that demarcation of ice?
Yeah, this is trouble because what we're going to have tonight is, just to recap, right now there's about 2-3 inches of snow on the ground south of the city, across parts of Long Island, down through New Jersey, and then it goes up substantially as you get down to southern sections of New Jersey. Travel is really tough right now in Delaware, Maryland, and down towards D.C. There's anywhere from 8 to even locally up to 8 inches of snow up to about a foot in some of the suburbs outside of the Beltway. And nothing in Boston, nothing at all from this system. The other way for tonight, though, there will be more to the north. There will be this messy, icy mix for the New York City area and suburbs. And it may start that way, but then go over to rain. And the same thing as you head on down towards Baltimore and D.C. Again, we have winter weather advisories. I'm looking at them right now. I mean, there are over 100 million people in the United States, in the eastern two-thirds of the U.S. right now, that are under some kind of winter alert, winter weather alert. Could be a winter storm warning, could be a winter weather advisory, and 30 million of those are cold weather alerts because behind it, temperatures are dropping down into the minus 30s and minus 40s. It's just winter is not quitting, and I think the line for tonight and into tomorrow morning's commute is going to be 287 in New Jersey, if we can think of that one. Let's say north of 84 in New York State and Connecticut. Those are the areas that I would watch out for. Anything north and west of that is going to be quite slippery.
Craig, thank you so much. Craig Allen with us, Bloomberg meteorologist.
Let me get an update here from Tucker Mountain. John
morning.
Tucker
We
has
can
an
now go to
update.
John
He's got the storm cam up.
This is live. Ari, can you see that?
Yeah,
live
get a visual
cam
of that.
It even covered up all the empty beer kegs on the front lawn.
It did.
That's how bad it was.
That's a bonus. Did the Christmas lights that you keep up all year?
It's all folk art
down
there.
You just changed the lighting. It was, it was Halloween lighting just a few months ago.
Very good. Thank you so much to Craig Allen for that.
It's a lot of people under alert, though. 100 million. Is that what you said?
Yeah, to me, it's partly February. Yeah. But in everybody's defense, we've had such easy winters recently. It's like, oh, so this is what it's supposed to be like. Back in the 60s, they were subversive. We're doing walk-up songs.
Okay.
Like, you go up to bat at Fenway or Yankee Stadium, you have a walk-up song.
This is yours?
This is my walk-up song. Every time I walk in the studio. The Standells, Dirty Water.
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
The president wants lower interest rates from Chairman Powell.
You can make the argument that this is a really rich market.
With Lisa Mateo on markets.
Stocks are coming off another record high.
And Michael Barr with news.
President Trump signing a wide range of executive orders.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
Good morning, everyone. Tom Keene, Paul Sweeney, Michael Barr, Lisa Mateo. Half the team off today. Lisa Mateo on assignment in warmer climes. Sweeney out with Grizz and Steamboat. I mean, you know, he's out there. Have you been to Steamboat?
I've never been.
It's not fancy. It's not like where Huw van Steenis goes. I mean, Hugh's like in St. Moritz going, oh my God, American skiing. Oh, gauche. That means left. I think it's left or right. I think it's left. Anyways, it's gauche, okay? It's not droite, it's gauche. But the answer is Steamboat's not Rocky Mountain skiing.
And fairly close to Denver. You can drive up.
Oh, no, it's long. It's on the other side. It's on the far side.
Of the Continental Divide.
There's two Democrats in the valley.
I see, okay.
Yeah, it's Steamboat. It's a very cool, very
When you were at Boulder, where did you go?
We would go to Steamboat a lot. And then
Arapahoe Basin, I imagine, late in the season?
The weekend would start Wednesday at 4 p.m. Thank you, the same.
Classes on Monday through Wednesday. Tuesday through Wednesday, maybe more like it.
There was no ChatGPT to get through statics and dynamics. Good morning to aerospace engineering at Boulder, Colorado. It was a great, great program. Good morning to the person that had a huge influence on me out there, Rebecca Struick. I believe 96 years old and still with us. But anyways, Paul's off today, and we're going to have a good time. Huw van Steenis with us, and I'm going to do an audible with him that only van Steenis can handle. Bloomberg surveillance this morning across the nation and worldwide, and Hugh's London as well. It's brought to you by Oppenheimer. Oppenheimer, they focus on the power of their thinking on you, creating customized plans to help achieve your goals. Put the power of Oppenheimer thinking into your investing, wealth management, capital markets, and investment banking as well. CPI here in 28 minutes with the Interactive Brokers Bloomberg Business Flash. John Tucker.
All right, not a lot of movement with the futures right now. The Dow futures down 39, S&P E-minis dead flat. The NASDAQ futures, they're actually up 46 points right now, up 0.2%. As you say, Tom, inflation back in focus. A lot riding on the CPI figures at 8:30, according to the trading desk at JP Morgan Chase Market Intelligence. They estimate the S&P 500 will fall as much as 2% in case the consumer prices rise 0.4% or more. The estimate is for 0.3. 338 companies in the S&P 500 have reported earnings so far this season. 77% delivering positive earnings surprises. 55% delivering positive sales surprises. CVS Health among the shares on the move right now, up over 10% in pre-market trading. Fourth quarter profit beating expectations. Adjusted earnings for the quarter, $1.19 a share. Lyft also among the most actively traded pre-market. Those shares right now 14% lower. They delivered a disappointing outlook for the first quarter gross bookings. And Super Microcomputer shares right now up almost 11.5% pre-market. They delivered an aggressive long-term revenue outlook. They say they believe it will meet the NASDAQ deadline to file their audited results as well. Once again, S&P E-mini futures pretty much flat. 2-year yield 4.29, a basis point higher. 10-year yield unchanged at 4.54. By the way, they do have skiing in the Alps of New Jersey.
Of New Jersey.
The Alps of New Jersey.
That would be Sussex County.
You avoid it, please.
The tow ropes are out.
It's a little different.
We have so much to cram in here. I got a script with Huw van Steenis, like a plan. Like if he and I are in Davos, we have a plan. We go see Barry at the piano bar, and life goes on. The president has just gotten in the way of my script. President Trump putting out moments ago a tweet, interest rates should be lowered, something which would go hand in hand with upcoming tariffs. Let's rock and roll America. So I got to start with that.
Let's rock and roll America.
Joining us now, the king of British rock and roll, Huw van Steenis, encyclopedic on banking, and of course at Oliver Wyman as well. Can a president force rates lower, or Chairman Powell speaking this morning?
Gosh, that's a great question to start. I was happier on the skiing than this. Yeah. Look, I think central bankers like to move at their own speed, don't they? And they ought to like to move incrementally where possible. So I think it's going to be tough. Look, tariffs. I think the market's still pricing in that they're going to be small and surgical rather than broad-based. If that's right, they're not as inflationary, so that you can see as inflation comes down, there's an opportunity to cut rates further. Look, if I think about it from the bank CEOs and CFOs I talk to, they're actually having a really good moment. They're in a purple patch.
Why are they in a good moment if the rest of us are in chaos?
Well, it's a really great question. So look, we've got a steeper yield curve, so they love that. Deposits are building up, so they got better funding. The credit environment is still really benign. There's very few bankruptcies, and actually with the Basel rules being kicked either into touch or certainly being what I think of as a bureaucratic fudge, if there's going to be bank capital neutral. I mean, let's be clear, BKX is up 43% in the last year. That beats FANGs. In fact, you would love this, that European banks are up 47. The European banks are being rehabilitated. You have to come back to Europe to talk about them sometime.
David Harrow, they still have life support out in Chicago.
In Chicago.
Get a question in here. Gura, get a question in here.
As we get our popcorn and watch the second of these 2 days of hearings, no doubt there will be some questions about Basel III and capital, and as Jay Powell persists without Michael Barr, the other Michael Barr by his side. What does the future look like when it comes to sort of the regulatory remit of the Federal Reserve? What sense do we have of the contours of that post-Michael Barr?
It's a great question. Look, so Tom and I have discussed before, if we look back in 2 years ago, what went wrong? It was a failure of supervision. It wasn't actually a failure of the rules. It was just they weren't being implemented and followed. Out in California. Yeah. The 4 banks which went bust, but certainly the first 3, there were just people looking somewhere else rather than looking at proper good old-fashioned risk management and kicking the tires. So the supervision really needs to be improved, and I think there's some work ongoing, and you could say FDIC needs to be part of that. I think the thing I learned was that the big banks are in great shape, and so actually you don't need to bolster them with copper, gold-plated, platinum-plated, crypto-plated, regulation. But maybe there's a little bit of tightness around about the smaller banks. Maybe the regional banks do need a little bit more supervision. So I think it's quite incremental. And I think we're getting back to sanity after this 19% proposed increase.
I had a question for French Hill, the congressman and chair of the Financial Services Committee. Didn't have time for it. I'll put it to you. He talks a lot about how regulation is preventing de novo banks from coming onto the scene, that he doesn't think there are enough kind of smaller community banks. Are there too many banks in this country? Where is the need for even more banks in the U.S. banking system?
Look, so I think it's true stateside, but the world over, heavy-duty regulations have forced smaller banks. It makes it much, much tougher to start up. That said, in the States, if you think about the banking system, we've got your top 18, 24 banks who are in pretty good shape. Then you've got sort of close to 3,000 community banks. They sit on one of 3 computer systems. They actually have scale, because they're drag and drop on a really high quality platform. It's the belly in the middle. And so, in fact, the 2 years ago, it was the belly which the 4 banks got in trouble. Yeah. Okay. That's where we need some M&A.
Let me frame this, for those of you across America. Gert, your question was brilliant. Why do we need to lean forward here? Huw van Steenis came out of Trinity at Oxford, PP&E, and had to get a day job. So he went to Morgan Stanley, where he was definitive on banks in Europe, but worldwide as well, and took down trophies like 12 years in a row or something. They had to force him out just so somebody else could win the damn trophy. He's worked with Mark Carney at the Bank of England as well. But to your question, is definitive. Trump loves Andrew Jackson.
Yes,
I mean,
he does.
Is that where we're going?
The portrait is back up on the wall. Yeah. I know in the Oval Office, but I don't know if you want to talk about Andrew Jackson. You should feel free if you want.
Well, we can if you want, but you should get Neil Ferguson on. I mean, I think what Neil always taught me, and actually I had dinner with Dick Berner last night, who you may remember, the chief economist of Morgan Stanley back those days.
I think I owe him money.
Oh, yeah. Well, Dick's on great form, and I'm sure he'll take that. Yeah. But so he said, look, the key lesson is that these clever PhDs, they haven't done economic history.
Right.
And actually, we learned that in the financial crisis. So actually, whether it's Jackson or whether we actually go back to the 19th century and actually, think about the impact of tariffs, about current account surpluses and deficits, history really matters. I think Neil's a better guest
Thank
than
you.
me on that.
No, this is really important. And to Richard Berner, folks, at Morgan Stanley, who was Stephen Roach, changed American economics. I think Dick Berner and I are on this forward guidance things, folks. You hear me talk about the dot plots. McKee and I are like, are you kidding me? And the answer is maybe they'll go away. A lot of that came from the excellence of Richard Berner. Huw, I got to rip up the script here. We have a glorious person at Bloomberg Intelligence, Robert Schiffman, who writes on debt and credit in MAGA. He has just put out a brilliant note suggesting that all this angst about capital raise there could be done with debt issuance because they don't have any debt and they make more money than God in free cash flow. Do you think the bankers like you used to be will convince MAGA that raising that capital is an easy process because of the wonderful financial position they're in, and they can raise billions in debt?
It's a great question. So look, let's stick on the bits which I have confidence, and let's move to the trickier bit.
Please.
It's raining fixed income at the moment. The inflows to fixed income, I think this year last year was a record in the States. I think it's going to be a new record based on what I've seen in January and early February. So it's raining fixed income. The demand for yield is huge. And I think the way to put it is, after 20 years where people didn't look at their fixed income portfolios, the last 3 years it's come back. So the demand side's there. But as you've debated tons of times, the structure of markets has changed a lot. And so it's going to be ETFs or it's private credit. And so there's a hollowing out. So I think the demand, I think you could issue plenty more debt.
Okay, so take a round number, $100 billion, 6, 7 companies. In the old days, you'd sit at Morgan Stanley and there'd be like 4 phone calls, right?
That's right.
Can they do $100 billion in debt with 7 phone calls? And the answer is yes.
They could do, but it's not necessarily the banks taking it down any longer. It's actually the investor side which is taking it down because the banks don't have that kind of capacity.
Fair.
Or to at least just sit on it at least.
Oh, come on, sovereign wealth.
Well, but I think, hang on, let's go back to history. So when Neil and I were chatting, this is a recycling of petrodollars. Why is it that everyone's in the Middle East? It's because those dollars need to find a home. And actually they are funding the states. And actually that could be one of the windfalls of the next 4 years is actually the recycling of these petrodollars.
As Tom Venmos Dr. Berner, let me ask you about how what we've heard from Mark Rowan and his cohort lately is resonating in the C-suites of the big banks on Wall Street. His ambition to grow private credit and to sort of present himself as this, not even alternative, but sort of driving force for financing. What are banks doing in the face of that to compensate or compete with what he's saying?
Look, so it's fascinating how many banks now talk about are prepared to accept there is a partnership model rather than just a counterpart. I think there's 2 ways to slice it. The traditional private credit business is higher yielding. It's leveraged finance, mid-market finance. And the way I think about it is that there's a retranching or reslicing of the banking system. The senior risk is being taken by the banks and the junior risk is being sold. And I think I've said to Tom, I almost think that private credit's the Ozempic to the banking industry. It's helping them shed weight. But, and here's a big but, the risk now is the private credit firms are raising so much insurance money. Over half of all inflows to private credit last year, I think, came from insurers. Well, we haven't got the final numbers yet. They need investment grade. So there you're now getting into the territory of the banks. Private credit only has about 5-6% share of that asset-backed lending.
Right.
And that's where they're going next. And that will put them into more confrontation with the banks.
This is chilling. It's like talking to David Goldman when he was at Bank of America in like 2006 or 2007. To translate this, folks, and Huw, help me out here. If private credit is going to pick up the pieces from the major banks and lesser quality, what are called junior tranches, is there an implied leverage within those tranches? I mean, are they pure and clean, or is there a shadow leverage within the new system of private credit and, frankly, private equity that we don't see?
Look, this is the number one question from regulators. You've obviously been having dinner with a lot of central bank governors. This is the number
you're
one.
With Richard Berner. I had dinner, folks, I had dinner with Jerome Powell last night.
Exactly, of course you did.
Surveillance disclosure,
But no, that's a great question. Actually, the Bank of England is doing work on exactly that issue. What's interesting, though, is if you think about the insurers who are putting money to work, they need investment-grade assets.
Right.
And that's what, 43%
unleveraged, pure and clean.
They don't do, let's say, NAV finance, so fund finance. The insurers do none of that. That's all being done by more the other parts of the ecosystem. So even if there is leverage, it's in sort of hands which are prepared to accept risky bets rather than the low-risk bets. So there is a kind of, Like
Okay.
in a way, I always think in life, we need the right holders of the right risk. You know, in a way, what we learned from, let's say, GE Capital, they had long-dated loans, but with short-dated deposits. We want
That
long-dated,
worked out.
exactly. So we need to parcel out loans, parcel out the risk to the right owners.
So go to the x-axis, which you're expert on. In private equity, they have not been able to liquidize previous investments.
Yeah.
Are you optimistic private equity can monetize their successes this year and into next year, 2026? And does private credit, will they have the same challenges of getting out of this stuff once they get into it?
Oh, it's two great questions. So
I'm like, it's a hat trick of great
You guys worked this out before.
Exactly. So this is my script, obviously, wasn't it?
It's a lot of rehearsal.
Exactly. It's tough. So all of the bankers that I talked to we're in November, we're jumping for joy about a huge IPO calendar for this year.
Exactly. Haven't seen it, though.
Maybe they did it just in time for bonus season and they were talking it up. But now,
Shonali Bassick sat there yesterday and said exactly the same
I missed that.
thing.
I'm so sorry. Okay, I'll credit Shonali with that. But obviously now they're saying in February, it's okay, but it's a bit slow, and it's that indigestion in the sponsor community. In fact, if you get some great data, if you look at M&A, strategic M&A, so like company buying company, is sort of more average levels for the last 15 years. It's bouncing, it should be a little bit higher. Mid-market M&A, again, is in line. It's the sponsor M&A which is weak, and that's why the private credit side are having to strike out for fresh pasture. So I think, look, you know, markets are here to embarrass and confront us.
As
At the
always,
moment, it looks like it's going to be a reasonable but sluggish year.
David, get one more in here with Huw van Steenis.
Just ask you lastly about the kind of relationship between public and private and partnerships that might come out of this new administration. So we saw the scene in the Oval Office with Larry Ellison and Sam Altman and talk of financing a big data center project in Texas and elsewhere. Obviously, as we talked about and lampooned a little bit a moment ago, there is the speculation about a sovereign wealth fund here in the U.S. How do seasoned private sector professionals look at that and navigate these proposals that, you know, admittedly don't have a lot of meat on the bone at this point, but does the notion of a public-private partnership change under this administration?
Oh gosh, it's a great question. Well, look, in some ways, you do already have a sovereign wealth fund, if I might be so bold, with Freddie and Fannie. I mean, they effectively are
for now
cheap financing for the moment. So I think you can do that. I mean, obviously, it depends whether it's through tax credits, through structures, how stable are the structures, what's the longevity of the partnership. But I think everyone's looking at this with it. You have an obligation to look at this seriously.
30 seconds, you came up with the phrase asset management barbell. Huw van Steenis on the ETF boom.
Oh, look, the fixed income ETFs are off the charts. Inflows last year in the States tripled on the year before.
What's the trap? It's a free lunch.
So the bit which is growing is like, let's call it active ETF. And it's the same discussion we had 20 years ago with, let's say, the PIMCO Total Return Fund. They're saying, I'll do the index and a little bit of Tabasco too. And the extra Tabasco gets you there. And last year there were two, I'm not doing company names this morning, but two funds who did really well in that space. I think that active ETF space for fixed income remains really interesting.
Michael Barr wants to know, do you use Tabasco on your full English?
No. I try not to.
Mrs. Van Steenis should be like, that's it, out the door. Huw van Steenis, thank you so much. Don't be a stranger.
It's been a real pleasure.
Really, with Oliver Wyman and Dan Tannenbaum, I should mention, just Huw van Steenis there. Brilliant on banks, and there they are, resurging European banks. Too short a visit now with the news in New York City. Michael Barr.
Thank you very much, Tom. And President Trump has directed agencies to work with Elon Musk's Department of Government Efficiency to significantly reduce the size of government. Musk was also in the Oval Office last night defending his actions and his future intentions.
We're also going to address the deficit. So we've got a $2 trillion deficit. And if we don't do something about this deficit, the country's going bankrupt.
Bloomberg government's Jack Fitzpatrick.
There's a lot of action around the cost-cutting and I guess government shrinking DOGE effort. And the latest one essentially tells agencies they are not going to be allowed to hire any more than one new employee for every 4 employees who leave the government. So this is essentially a government shrinking attrition plan.
Bloomberg government's Jack Fitzpatrick. President Trump just made a statement about interest rates just a few moments ago in a Truth Social post. He says interest rates should be lowered, something which would go hand in hand with upcoming tariffs. Mark Fogel, an American teacher who has been deemed wrongfully detained by Russia, has been released and returned to the U.S. Fogel was brought to the White House where President Donald Trump greeted him.
President Trump is a hero. These men that came from the diplomatic service are heroes.
Snow, sleet, and freezing rain are expected to continue to pummel the central Appalachians and mid-Atlantic states, while California readies for a storm that could flood areas ravaged by the recent wildfires. Global news 24 hours a day, whenever you want it with Bloomberg News Now. I'm Michael Barr. This is Bloomberg. Tom, David, John.
Michael Barr, thanks so much. CPI in 10 minutes. David Gura, what are you looking for in the inflation report?
You know, I just want to check, per what Yelena said a moment ago, services is where my eyes are going to drift when I see how much has changed.
Remember
there.
How we were slaves to the service index 6 months ago? And I agree, it's sort of still there. The goods services separation of goods being really quiescent. And I'm sorry, folks. We all know this. I'm not telling you anything you don't know. Across the nation on Apple CarPlay, Android Audio on Sirius. Good morning, 99.1 FM in Washington. Nathan Hager shoveling. Extra duty there.
Outside the bureau.
He's got the battery snow.
Metaphorically?
Yeah.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash, brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitment. Offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. Let me start with the most active pre-market. Supermicro Computer shares 14% higher after delivering a bullish forecast. Trying to figure this earlier, Intel shares, they're also among the most active pre-market, up close to 6%. It looks like Vice President J.D. Vance is behind this. He made some bullish comments about semiconductor manufacturing in the U.S. at an AI summit in Paris. 8:30 Wall Street time, of course, CPI. Anna Wong writes, there's a risk seasonally adjusted core could register an acceleration in January. U.S. companies putting up one of their best earnings season in 3 years on the back of robust economic growth. Earnings per share on track to jump 12.5%. It was anticipated for a 7.3% rise before the season kicked off. No thanks. Spirit Airlines again rejecting a third takeover bid from budget rival Frontier. And Google's CEO, speaking at the World Government Summit in Dubai today, says quantum computers that are practically useful are 5 to 10 years away. Right now, Dow futures down 19, S&P E-minis unchanged, NASDAQ futures up 35 points. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. David and Tom.
John Tucker, thanks so much. We're going to go to Liz Ann Sonders now, the inflation report here in 4 minutes with John Tucker, and then finish strong with Liz Ann as we can. Full disclosure, folks, in honor of the Los Angeles Angels, we're playing Nickelback at the end of the hour. We're giving Liz Ann a warning.
Turn down your radio if you
turn it down as she chooses. Liz Ann, I want to go to the heart of the matter. And you have had leadership on this in the industry going back to your days with Lou Rukeyser. In the last 10 years, a given blended stock fund is up 12% per year. In the last 10 years, a given blended bond fund is up 2% per year. Inflation is a friend of stock investors, right?
In fact, a lot of people think of asset classes like gold as sort of the ultimate inflation hedge. But over the very long term, the only asset class that has consistently outperformed inflation is U.S. equities. So you're absolutely right, Tom.
And where are we now in that continuum? I mean, in honor of pitchers and catchers, Lizanne, Gura's given us the innings metaphor. Where are we in the confidence to be in equities with inflation and all the other noise?
Well, here's the tricky thing about inflation. When you're in a more volatile inflation backdrop, like was the case from the mid-'60s to the mid-1990s, that's an era we've been calling the temperamental era. That was an era when bond yields and stock prices were inversely correlated. And that's because inflation was more volatile. You had bigger swings in inflation. There was more heightened concern about some of those swings in inflation. So for instance, higher yields in that backdrop often meant inflation was reigniting negative for equities. Fast forward to the period from the mid-'90s up until the first year or two of the pandemic, the so-called Great Moderation era, that relationship was completely opposite, and bond yields and stock prices moved consistent with one another. And that was because we had very little inflation volatility, not a lot of inflation risk. So higher yields was typically a sign of stronger growth without the attendant problem of inflation. We're back in that negative correlation territory right now. And I do think it could mean we're in a different secular backdrop.
David Gura, squeeze one in here before CPI.
Yeah, Lizanne, in these data, we're not going to get any indication of what Donald Trump's policies might mean for inflation in this country. But I wonder if we can go back to 2018 when we had the first kind of round of a Trump trade war. What can we learn sort of from that experience that might be applicable here, if anything?
Well, we didn't see overall inflation pick up. You didn't see it in PCE and PCE goods. But if you pull out the tariffed goods and track them in 2018 into 2019, a significant amount of inflation in those tariffed goods. I think, by the way, guys, I think the PPI report might be a better tell in terms of tariff-related stuff than the CPI report.
I took tomorrow off, Tom. I'm not going to be here for PPI.
Crushed. Lizanne and I are pros. We'll be here. Lizanne Sonders with us. Now, let me set up the data screen here. I think it's so important. As I've said, I just don't think this is a snooze fest. Dr. Anna Wong saying somewhat the same thing here on core, maybe lifting. Dollar stasis is what I've got. 108. Mark McCormick at TD Securities. Brilliant yesterday. That was very valuable on foreign exchange. On the euro, 103.69. We got to quote sterling for Huw van Steenis. Lifts 123 up to 124.47 as well. In the yield space, good morning, Kathy Jones. The 10-year real yield, 2.06%. Be interesting to see where that moves to here. And the 10-year yield right now, 4.53%. I got red and green and screen mixed. We're waiting to see what we got. But critically on the VIX, get the VIX into a 15.99. We continue with Lizanne Sonders here after the report. We welcome all of you across the nation, particularly out on YouTube. Subscribe to Bloomberg Podcast. John Tucker.
This
all right, here we go.
Is breaking news from Bloomberg.
Yes, breaking news on CPI. Hotter than expected. Month-over-month CPI of 0.5%. When you strip out food and energy of 0.4%. The expectation for both was just a rise of 0.3%. Year-over-year CPI coming in at 3%.
Wow.
Hotter than the previous month. The expectation was for 2.9%. And CPI ex food and energy year-over-year, core year-over-year of 3.3%. The expectation was for only 3.1%. Hotter inflation than we had anticipated. And that is your special report, breaking economic data. David, Tom.
John Tucker, thanks so much. And huge moves in the market. The VIX at a 15.91 goes out to 16.64, up 0.62 points. It's not that sensitive. We'll get more on that in a number of minutes. Futures negative 57. Dow futures negative 412, down 0.9%. NASDAQ down an equivalent amount. Small stocks hammered. The 2-year yield out a solid 9 basis points. I don't know if Sweeney will come home off that statistic. 10-year yield, 4.61%. I look at the 10-year real yield as a litmus paper. Liz Ann Sonders with us with Schwab, 2.13% is a 7 basis point move there to a higher yield regime. Liz Ann Sonders, it's unfair to go into the minutiae here because, you're doing this in real time and, I understand that. But across the board, a la what Anna Wong said, this is not just one statistic. Critically, month over month, which is what Mike McKee really looks at, year over year. Jason Furman will give us an ecumenical study in about an hour. All inflation boats rise here, don't they?
They do. You're right. The core headline, the month over month, the year over year, the overall headline, all hotter than expected. And it's in keeping with some of what we've seen in inflation expectations. Now, the University of Michigan version of inflation expectations had an extreme divide in terms of along party lines, Democrats having a huge expectation for higher inflation, vice versa for Republicans. But the 5-year break even has gone from 1.9% or so last fall up to, in the well into the mid 2s. So you're seeing it in other areas. And I think it's certainly supportive of what we heard from Powell yesterday, which is they're in no rush to move back to easy policy.
I said the VIX would lag. We just had a 17 print in the VIX up a stick. A stick is Liz Ann Sonders talk for one big figure. I have to use that jargon.
I
with
appreciate that.
Liz Ann here. Even a BitDog down 1,500. BitDog now at 94,000 as well. David Gura and Tom Keene on YouTube. Thank you so much for being with us across the nation in your commute, in your living room and office. Honored to have Liz Ann Sonders with us, Charles Schwab. David?
Liz Ann, let's pull back a little bit here because we see the immediate market reaction. It's something I wanted to ask you about because we had the Michigan survey last week and saw the reaction there. There has been a reaction, dare I say, at times an overreaction to some of these most recent data points. As you look at it more holistically, how is the market processing sort of the broader view that we're getting of the U.S. economy?
Yeah, one of the interesting things, and you're picking this up in some surveys of institutional managers engaging what is driving stocks. And I think we've actually moved a little bit away from things like monetary policy and broad macro trends, and more of the connectivity to what stocks are doing are the specific fundamentals, but there is that policy component too. I think the NFIB data out yesterday was pretty compelling in gauging at least small businesses' reaction to the manner by which we get these tariff-related announcements. And everybody is now trying to dig in using the fine-tooth comb, figuring out which industries, which companies are hurt or benefited on the import side of things, on the export side of things. And I think that's going to come into play more and more at the individual stock level because of that shift to fundamentals and things like earnings, now that we're in earnings season, driving stock prices more than just broad monetary policy or just valuation expansion. So I think that's an important shift relative to last year.
I pull up WIRP here on the Bloomberg, Tom. I see traders shifting their next Fed rate cut prediction to December from September, so pushing it back even farther still.
Yeah, but we're the economists, Liz Ann Sonders. I mean, are we ready within the stock market, Liz Ann, for the shock of stability in rate cuts, or even the parlor game of rate increases? We're nowhere mentally near ready for that, are we?
I think we're mentally ready for a pause that lasts throughout the course of the year. Okay. I think there's been, even before the CPI report, you had only a little more than one cut priced in. Now that's gotten pushed out. I think that is the parlor game because a data-dependent Fed and added to that the policy uncertainty to say, yeah, we're confident that the Fed's going to cut in December. That's just a fool's errand to do that. I think you're absolutely right, though. I don't think the market is prepared if the Fed feels they actually have to turn back into tightening mode.
Right. I want to go to nominal GDP. Jason Furman's essay, there's the new foreign affairs is lights out. Stephen Levitsky with a great article. David and I will talk about that in a bit. Furman, taking a look back, 2020 hindsight on the Biden administration, and Liz Ann, he mentions nominal GDP. If I get a higher or stable inflation component, do you model out ample real GDP to keep the corporate animal spirits going?
Well, I think nominal GDP is important. That feeds into revenue growth, which is a little bit more correlated to things like employment trends and also pricing power. So I think it's the volatility in the inflation component that matters a little bit more than the level, because of the uncertainty factor that creeps in when you're in an era of volatility, right, in terms of that deflator.
Right now, reporting on Twitter with a real job. See, Sonders has an entire team to do Twitter. She hasn't done a tweet since Led Zeppelin announced their summer tour. Catherine Jones out on Twitter with Schwab, CPI up, overall up, core up, not what the market was hoping for. That report, David Gura, from Kathy Jones.
Well, you've given me a great segue here, because I know that Kathy and Liz Ann have a podcast together on investing, and Rich Clarida was on that most recent episode. He won't return our calls, right, but he was on with them. What did you take away, Liz Ann, from what he had to say about inflation? What was the headline from his commentary on how he's seeing inflation today?
There's a tremendous amount of uncertainty, and adding in the policy uncertainty makes it a difficult exercise. There certainly is a slight bias on the upside, and there's the stickiness component of it. But he's no longer at the Fed. But I don't envy the folks there. Powell coming out yesterday saying we don't take that into consideration, but we know some Fed members are taking that policy uncertainty into consideration and trying to gauge their own outlooks.
As we wrap up here, I go back to my first question to you. That is just noting the fact that this isn't reflective of what we've seen in this new administration. We've talked this morning all week about the kind of inherently inflationary policies we could see put in place here, chief among them the tariffs policy from this administration. How do you think about that vis-a-vis inflation going forward here, and how that's going to color this market in the months to come?
Well, if we go to sort of the maximum end of what's been proposed and then infer what that means for inflation, you can look at data out of folks like Peterson Institute. You're talking about a close to a 1% jump in inflation, but that is really not it's a step up in prices more so than a trigger for ongoing year over year or month over month higher inflation rates. I think, though, that's important because consumers tend to think in level terms, specifically what were prices back in 2019 pre-pandemic? What are they now? So it is important in the sense that the average person thinks in level terms, whereas folks like us get into the weeds of month over month and year over year and core services ex housing. So I think the level step up is going to be felt, even if it doesn't translate into an ongoing higher inflation rate.
Liz Ann, just give us a pro tip here. Where are you able to buy eggs right now? Where is Liz Ann Sonders buying eggs? I really want to know.
At the supermarket. I pay what I need to pay for eggs.
That's it.
Pay what you need to
That's
pay.
it.
There you go.
$14
They're there if you can afford it.
I haven't gone out and bought my own chickens to hatch my own.
No free-range chickens.
Go to the market.
Yeah, Liz Ann Sonders, thank you so much. At $14.99 a dozen.
You going to get a coop, Tom? You should get a.
Carl Weinberg wants me to.
Yeah?
I'm in Central Park.
All right.
I just put up some fence overnight.
Keep it on the roof of the building.
Keep it on the roof.
See it. I can't. The Sikorsky land's in the building. But the answer is get it out in Central Park. Sneak out there at night. Put up some fence.
Yeah.
Keep the coyotes away. There are coyotes
in Central.
There are coyotes in Central
David
Park.
pronounces as coyote, by the way, which
yes.
is, I believe, the correct pronunciation.
Right? Coyote.
What is this, a Joni Mitchell thing?
Coyote.
Remember Joni Mitchell's song Coyote?
Yeah.
It was great. I mean, it's back.
You going to play that for my walk-up song?
No, I'm not. Yeah, no. I'm afraid to think about your walk-up song. Let's save the show right now. An important inflation report with futures at -62 from the Interactive Broker Studios, the Bloomberg Business Flash. John Tucker.
All right, I'll start with yields. The 2-year up close to 10 basis points, 437 right now. The 10-year is up 10 basis points. 463 right now, and that is helping drive the futures lower. The down futures down 1%, 448 points lower. The S&P futures down 1%, 63 points lower. The NASDAQ futures down 250 points, down 1.1%. And as David mentioned, the swaps market now pricing in a full 25 basis point cut for December. That's it. Headline CPI up 0.5% for last month. Nobody in the Bloomberg survey economists called it at 0.5%. All 73 economists were at 0.4% or lower. The so-called supercore services gauge, that soared by over 0.75%, 0.76%, the most since January of last year. Back to you, David and Tom.
Gura nailed that. I can't remember if we were on mic or off mic, but you said you were watching Services Supercore.
That's right, yeah.
Does this change Chairman Powell's testimony? John, we're going to have that at the 10 o'clock hour, right?
Yeah.
I'm sorry,
gives
it's
me a
got to
huge
change
break.
it.
It gives you a huge break.
That's I call it the Powell bathroom break.
Well, I just expect more caution, so perhaps more anodyne than it might be otherwise. I mean, he'll be pushed on it, but...
will he? I mean, are they sophisticated enough to know that?
We just spoke to the chairman of the committee. I think he's a
French Hill will
gentleman
be on top of it, but...
Yeah.
I'm sorry, folks. It's changed dialogue out there. And, we'll get Anna Wanning-Ong and all of our other worthy guests to really parse.
We'll get her after her latest victory lap. I feel like she's been doing a few of them.
Yeah.
We should note out pre-CPI, there was a tweet
from
the President of the United States of America
urging lower interest rates.
Interest rates should be lowered. It's something which
it's
would
hard
go
to do
hand in
that
hand.
with what we've seen. Again, the VIX up a stick. Futures, let me give you the percentages. SPX in 1%, Dow in 1%, NASDAQ 1.1% down, Russell down 1.8%. What a perfect time to talk to Gina Martin Adams, driving the force at Bloomberg Intelligence, has been brilliant on double-digit earnings growth. To pick up from where Lizanne was, Gina Martin Adams, if we get inflation, is it a constructive inflation that can solidify revenue growth across the Bloomberg Intelligence world?
It does look like we're going to see revenue recovery in the index, though the pace of revenue recovery is probably somewhat grim relative to expectations. I think that the really big key to 2025 is not that we continue to recover. It's that we may not be able to recover at the pace that is expected by the equity market. There's this really interesting dichotomy in the equity market right now, as you're seeing it play out real time. And that is, we're expecting not only very strong revenue growth, very strong earnings growth to emerge, but we're also expecting the Fed to cut. And that environment is inconsistent. And so that's why you see the market react so negatively to CPI. But also, when we look at the average price reaction to earnings growth, when stocks are reporting, even when they're reporting beats, their price reaction has been fairly grim. So I think we've got to work that dichotomy out. We've got to work that friction out of the system. The market's got to get more rational expectations and also generally get in line with what the Fed is doing. And the Fed is saying, we're on hold.
Can you help me? This is a dumb question, but I note the dichotomy and wonder why it's persisted as long as it has. So Tom asking a very good question. Are we going to hear anything different from the Fed chairman today? We heard him say yesterday a lot of what he said at the last press conference. He's been sort of reading from the same hymnal over and over and over again.
Right.
How has this dichotomy persisted, and what's going to be the catalyst that gets the market to kind of move away from what seems like a fool's expectation that there are going to be cuts in the near term?
Right. I think it's a great question. And I think the dichotomy can be explained by what's happening in the segments inside the equity market. So the greatest expectations really are centered around AI, tech, TMT industries, where we've seen the greatest degree of earnings growth. These also tend to be less inflation sensitive groups, right? They're more thematic. It's all based on AI and our anticipation of AI really changing the productivity outcomes for the world. And that is deeply embedded in tech expectations. We're seeing those expectations reverse somewhat, especially as a result of DeepSeek, but we've really seen tech expectations in a process of rationalizing since June of last year, when Mag 7 peaked in terms of their performance relative to the S&P 500, but it's just slowly getting dismantled. People aren't really giving up on that. At the same time, the rest of the market has been very slow to recover. And the rest of the market outside of TMT industries is really has really started to count on the Fed getting their back, enabling that recovery. So that the two-speed market is still a big story into 2025.
Gina Martin Adams with us here off the inflation report with the VIX out over a stick 17.05. I want to emphasize, folks, out on Twitter, the series of charts from our guest, Kathy Jones. We were just busting her chops. She does brilliant work at Schwab, and she's got a wonderful chart showing the inflation stasis since the kids went back to school in September. Michael McDonough owns a high ground on this. Everyone in the industry uses Michael McDonough's colorful bar charts of the makeup, and it's just as simple as this, David Gura. McDonough goes right to the Gura index, supercore CPI month over month is a spike up, but further than what many people expected.
I'm noting here, just as I think about all of this, and Tom, maybe you want to pick up on this, as we were talking about sort of what Fed Chair Jerome Powell might have to deal with. We've talked about the tweet from the president this morning, and we've seen this Fed chair so expertly, Tom, bat away suggestions from reporters, outside analysts, that it could kind of succumb to political pressure. Safe to say this makes his job much more difficult. That tweet this morning, coupled with the inflation data today, makes it harder still for this Fed chair to weather that kind of political storm.
The political, absolutely. And the question is, we know this president's beliefs from his business career, and it was only a matter of time till we got the kind of tweets that we got today as well. Gina, do businesses, can they adapt and adjust? My core theme is corporations always adapt. Can they adapt given a leveling of inflation and not a true disinflation?
Yeah, I think it's a great question. And what we tend to see is that really depends upon the degree to which producer prices accelerate. This, I think, is the crux of the problem for corporations right now, is at least until this data point, producer prices were accelerating at a faster pace than consumer prices. Producer prices, of course, are littered with energy products, but also industrial goods. Sort of those core imports are a huge input to ultimate company costs. So it really is not just necessarily about a deceleration or stabilization of inflation, but it's the difference between the cost that they're paying for inputs and what they can charge the consumer on the other end. That's been working against them now for 2 months. We'll see over the course of this week if it continues to work against corporate margin outcomes. But it is a very different climate than we've been in for the last 2 years. Admittedly, we not only had disinflating inflation, but we also had producer prices decelerating faster than consumer prices. That was the idyllic environment for corporates. We're moving past that. And so you should expect a period of give and take at the very least to emerge. On top of that, you've got a lot of business uncertainty right now, even in small businesses, which vastly celebrated the election post-November, have started to pull back expectations because they don't know what the rules of the road are. Gina, and so we need some stabilization in policymaking to help enable growth there.
We got to run. Let's do this again. Let's get her in the studio again. Gina Martin Adams with Bloomberg Intelligence, brilliant on double-digit earnings growth. David Kelly scheduled to be with us here with J.P. Morgan, but we're going to squeeze this in right now as best we can. Again, futures in negative 56 off the CPI report. The VIX was a 17 level. I'm going to call it stasis, but a huge yield reset. Out 9 basis points on the 10-year yield, 4.62%. I watched the 10-year real yield, as Kristy Akullian does at BlackRock, 2.13% as well. Joining us now from BlackRock is Kristy Akullian, head of iShares investment strategy. So do you go home and blow up the year view because of higher inflation? Are you going like, why am I here? I got to go back and rewrite 40 pages?
Well, I'm certainly wishing I was on 20 minutes ago and not right now. I'd say, I think that, we came into this year pretty bullish. We've been overweight U.S. equities, but I feel really good and confident about the places that we've chosen to allocate to within that, as opposed to just broad-based. So we've been talking for a long time about the need to stay up in quality. We've been staying away from small caps. What you saw in the inflation data today is that it's on a relative basis, at least. It's those higher quality companies that we think can outperform. Small caps are going to face the headwinds of higher exposure to those higher interest rates.
What is, when you and Gardy, when you're at BlackRock, they're on speaking terms. When you're at BlackRock,
I hope so.
She's my boss.
What is the marginal appetite for equity ETFs right now? Is every day like, OMG, the money's coming in? Or are people scared stiff.
No, I think people are still very much allocating to the equity markets. It's been an incredible year for fixed income as well, so that's been certainly breaking records. But one thing that was so interesting to us is that even in a 25% positive year for equity markets last year, we saw 3 times more money allocated to cash funds, so money market funds. So we still think there's a lot of money on the sidelines. We're still talking to investors about putting money to work. And interestingly, even though we saw growth underperform value in January, we saw one of the largest spreads in terms of allocation to growth ETFs relative to value. So people are still convicted in this market. They're still convicted in the AI theme. Again, we just think that it's important to do so in a high quality way. So something like QUAL has been one kind of our top ticker of choice.
What is it?
QUAL is our quality ETF. So it's an equity market, sector neutral. You get the top quality companies.
It's like 80% the triple leveraged all cash fund. That's how you do it. I talked to Larry about it. It's in registration.
Gina Martin Adams a moment ago was talking about this different environment that, what we've seen here in terms of an idyllic environment for corporates is changing. And I saw you nodding out of the corner of my eye. How do you see that challenge manifesting itself here in the months ahead?
Yeah, absolutely. And certainly it is an environment where we see and expect to see a lot of uncertainty. And uncertainty, as we know, is bad for markets. It can be bad for consumers. It can be bad for companies. But we're still really grounded in what we're seeing in terms of earnings. So, broadly, I think the macro picture still looks positive and that growth is still really strong. Corporate earnings have come back stronger than expected. So we're really focused on those fundamentals.
Tell me about leverage. I keep bringing this up. I make jokes about it, folks, but it's not funny. Leverage kills you. And the answer is it's all the rage right now. Double leverage, triple leverage, Mag 7, whatever. What do you actually see from people buying or selling leverage? And also, what do you see in your research?
Yeah, it's not a space that we play. So, we are not in the triple
Why
leverage.
don't you play triple leveraged?
We think about the appropriate nature of funds for all types of investors. So we like to launch institutional quality funds that can be used by end investors and direct investors as well. So again, we're focusing on portfolio building blocks, not necessarily trades. So that's just not our space.
He's trying to get his triple leveraged all cash fund in your portfolio.
I saw Larry.
I'm trying to talk about boring quality, and he wants to go leverage.
Avenue when I said it would be a perfect BlackRock product.
Yeah? He's thinking about
What did he
it.
say
He said
to
he's
that?
going to go think about that one. I do hear still a chorus among managers and advisors talking about small caps. This is a moment for small caps. Are you singing from that hymnal? Are you in that chorus as well, or are you steering clear?
We have been pushing back against that for a while, and I think the modal question we get from investors that we speak to is now finally the moment for small caps.
Yes.
We saw and sort of anticipated we were going to get a short, sharp rally after the election, but it wasn't something that we wanted to chase. And specifically, we didn't want to chase it because we think the fundamentals are still against that trade. So small caps are more exposed to higher interest rates, and also they tend to need accelerating growth. And even though we think growth is going to stay positive, we do think it's going to decelerate this year. So the sad answer for a lot of the folks who we see, a lot of the positioning data that we look at, investors are very overweight small caps. We still don't think that it's the moment for that just now.
This is brilliant. We got to have you back here when it's not absolutely nuts like it is now. David Kelly with us here in a bit. Kristy, as simple as I can, the Mag 7 in the love here, are people buying at the margin, or is there a new test here to the Mag 7?
I think investors are looking for the broadening out trade, but they're still looking for large cap growth. So, again, we're not seeing as many flows into small caps, not into index value, at least. I think there's opportunity in the active space. But, when we look at the composition of returns last year from 2024, we saw about half of the S&P 500 returns were due to earnings per share growth, so fundamentals, and half was due to valuation expansion. If you look at large cap growth, 80% of that was driven by fundamentals. If you look at value, it was less than half driven by fundamentals, and small cap, 0 of it driven by fundamentals. So again, people are following the earnings, people are following the growth. We like the corporate profitability story, and we're staying a bit away from small caps.
Are you based in New York?
I'm based in San Francisco.
It's better there. I've heard.
At least the weather.
It's a new trend. Can you get us good Giants tickets?
Yeah, absolutely. You come visit. I'll take care of you.
So we're going to go first to Little Rock, to French Hills Minor League Stadium, and then go see a Giants game in San Francisco.
Pop on over.
All right,
San Francisco's back.
My friend Carl he went to every major league stadium.
Yeah.
That's so cool.
Over a summer?
Yeah.
No.
Yeah, I think it was
several
over, you know,
summers.
it's like
Yeah, Sam, you don't want to come in the summer. September is the sweet spot for September.
Early autumn.
Kristy, thank you. Don't be strangers. Kristy,
thank you so much for having me.
With BlackRock as well. Right now, the VIX 16.83.
A lot more red on the screen, if I can tee you up for that.
You nailed that. I mean, my word, Gura, equities, bonds, currencies, commodities, just absolutely nailing it here. But yields are higher, seriously. The 10-year yield out 9 basis points. I'm going to get right to it now. What we're going to do here, this is so important, we're going to blow out the show open and the song ending here. We had Nickelback tuned up.
I know. You
David
that.
Kelly or Nickelback?
I feel like Liz Ann Sonders succeeded in getting us to scuttle that.
And David knows where I'm going on this. When David Kelly and I met, we were younger, to say the least. And one of the great moments of this bull market and the oddities of equities, bonds, currencies, commodities is there's not a lot of people with bull market experience when it ends. David Kelly joins us now with JP Morgan. I just can't say enough about the team he's put together there of thinking responsibly about investment. And you were weaned on this in Boston at Putnam. Mm-hmm. You and I have tattooed to our soul the collapse of the Putnam Voyager Fund.
Yep.
It was the go-go fund. Now, I'm going to suggest, David, we don't have that exuberance right now, that I don't see it. But what's the radar you and your team use so that we can avoid the Putnam Voyagers of this decade?
You know, there's a very old saying that that you don't make the same mistake twice. But the problem about the family of mistakes is a very broad family. And there's always some cousin or relative of the mistake you made.
A lot of inbreeding
that's actually a quote from the book Reminiscences of a Stock Operator,
which everyone should read every 5 years.
Exactly. But if you look at the mega cap tech companies, it's not the same thing as a dot-com bubble, of course. But you still have very high valuations, and you've still got and you've got more concentration in the S&P 500 now than you had back in the dot-com bubble. So there are bubbly aspects to this market. And the market is priced for perfection. And then if you have an imperfect number like the CPI number today, then you take a shellacking. And the thing that gets hit the most at the end of a bubble of a bull market, bull markets end up being bubble markets, is the thing that the area that the bubble was concentrated in, and that's the thing that's most important here for people to think about. It doesn't, markets will come, bear markets, bull markets will come and go, but you don't want to be overweight, the overhyped at the peak of a bull market. And that's what I think investors need to think about.
I keep coming back to this, and we've talked a lot about the Fed being data dependent versus data point dependent. Yeah. How do you view the data that we got today in kind of a wider, more holistic lens? We see the reaction in the markets thus far, but what does it tell us that we didn't know yesterday or a week ago?
Actually, not as much as you'd think. The thing about when you have a surprise on CPI, people forecast CPI pretty well because all the core things are pretty easy to forecast. What causes a problem is the usual suspects, and the usual suspects are auto insurance, airline fares, hotel rates. So hotel rates were up 1.2%. Airline fares were up 1.4%, and auto insurance was up 2%.
These are all things that Tom has been complaining about at length in recent weeks.
I priced Paris last night, and versus 12 months ago, I'm spending $2,000 more. Yep, that's a fact.
Yeah.
From X to X plus 2,000. I mean, that's what he's saying.
He's not staying at the Hampton Inn.
Well, yeah, and it's a
he
difference.
He has his own inflation gauge that he follows.
That's a wealth effect. We've both been doing this long enough that, it used to be wealth effects and consumption weren't that important. Right. But there is so much wealth right now relative to 20 years ago, 30 years, 40 years ago, that when you have a wealth surge like we did last year, what do rich people spend money? And what do rich people spend money? Taking trips to Paris. That's
joining us here at the hour top, David Kelly of JP Morgan. This is so important. We're going to forego the festivities of the market open. We forgo Nickelback. That was my pitchers and catchers thing. You should have seen the
even harder to dispense with that than the show open.
Tickets at Fenway Park years ago.
You went?
Kelly would be down. Peter Lynch would be backed up 12 rows back, and Kelly's down by the third base dugout. It's the rock star seats. David, I want you to talk about the moment we're in and how people scared participate in the equity markets. JP Morgan has this huge platform of measured of a measured approach within a new media frenzy you and I didn't live years ago in Boston.
Absolutely. And you've just got to watch valuations. There are plenty of things in global equity markets which have got perfectly reasonable price tags. There are just a few things which dominate U.S. markets which don't have reasonable price tags. And you've just got to be determined to focus on, I'm going to buy stuff at reasonable valuations. This makes sense, both U.S. stocks and international stocks. And I'm going to try to do everything I can to underweight the stuff that is carrying PE ratios of 30 times or 35 times or 120 times. You just need to do that. We don't. You never know the hour nor the day that a bull market breaks and you end up in a bear market. You just don't know how to time that. But you do know how you position yourself before that really determines how you're going to go through it. So overall the economy looks good, but we've got a lot of policy uncertainty. The problem is the equity market is priced for perfection, or part of the equity market is priced for more than perfection. You just need to be underweight that.
I'll show my age here, but does a bull market end with a bang or a whimper? Customarily, you said you'd know the day or the hour.
That's a really sophisticated question. Seriously.
No, it ends with a bang. I'm sorry, it's not going to just wimp out. We're past the point where the market can simply slide back into a bad year or two. We're going to have a significant bear market at some stage. We don't know when it's going to start, and you don't want to not participate. Just don't participate in the stuff that looks obviously crazy in terms of valuations.
David Kelly was with J.P. Morgan. How do you fold in Kasman and Feroli's work? Michael Feroli making history, I'm going to say a decade, 8 years ago, with a shocking potential GDP number under 2%. Mm-hmm. Do you work off of J.P. Morgan economics modeling still a disinflationary tendency? John Williams yesterday reaffirming a path back to 2%. Yep. Is that a foundational call still?
I agree with them on that. I look at their stuff very, very, very closely. We work independently, but I agree with them on that because if you look, yes, we've got a surprising number today, but if you look at Shelter was 4.6% year over year last month. It's 4.4% right now, and it's still too high based on what we know is going on in the rental market. Auto insurance, saw a 2% increase, but it's double-digit year over year. It's not going to be double-digit year over year by the end of the year. So that part will go away. But what I am concerned about, and I think the Fed is concerned about, is what happens if we have more tariffs? What happens if immigration gets much tougher? You've got higher wages, and what happens if we have fiscal stimulus in 2026? And that's what's keeping the Fed more nervous.
30 seconds. Every single parent I know wants their kids to go to school in Europe. It's the new rage here. Mm-hmm. Sell Trinity right now. Everybody's looking at St. Andrews this and go down to Paris and, the Rome and all that. The real academics is in Dublin, isn't it?
Well, you actually have a pretty good time there too. But you learn a lot. What's a college education really about? And you will learn a lot about life in Dublin.
There you go.
David Kelly there with wisdom on his Dublin. Thank you so much with J.P. Morgan. This was a real treat to have him in here this morning, particularly with this news on inflation. The VIX on a stick, 17.09. It wasn't one statistic. Many of the numbers floated higher. Major shout out to Anna Wong at Bloomberg Economics, who warned me. She said this is more than a January effect. In spades, we saw that. With the Interactive Brokers Bloomberg Business Flash, John Tucker.
All right, let's start off with recapping inflation. Hotter than expected. No rush for the Fed to be cutting interest rates, given this report. Treasury yields right now jumping. The 2-year 7 basis points higher, 435. The benchmark, the 10-year, up 10 basis points. That is at 463. Stock futures, they are lower right now. The Dow futures down 1%. S&P futures 1.1% lower, down 67 points. The NASDAQ futures 259 points lower. That is a decline of 1.2%. You had core consumer price index increasing 0.4% for the month of January after the 0.2% advance for December. Now, from a year ago, it rose 3.3%. By the way, the egg index, there is such a thing, that rose by 15.2%. And the so-called Supercore Services gauge soaring by 0.76%. That actually is the most since January of last year. Real quick, pre-market shares of Supermicro Computer, they are up right now 10%, delivering a bullish forecast. Intel, among the most active pre-market, up 6%. That after the vice president, as far as I can tell, said at the AI Action Summit in Paris, AI chips will be made in the U.S. And then you have CVS Health Corp rising sharply in early trading, fourth quarter profit beating Wall Street expectations. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. David and Tom.
John Tucker, thanks so much. David Gura in for Paul Sweeney and Tom Keene. Thrilled that you're with us today. Out on YouTube, this is an incredible treat. We're going to get right to it because it's going to be a too quick 20 minutes. Tina Fordham has provided phenomenal transatlantic perspective over the recent years, and she's just continually delivered to us on international relations and how it folds into the markets. She becomes ever stronger, joined by Ebrahim Rahbari, who was at Citigroup and Legendary, and to have Fordham and Rahbari together today is really what Bloomberg surveillance is all about. Tina, the moment that we're in right now, I assume your 5-page report has become a 20-page report. Distill it into one observation of how, whatever our political persuasions, how we survive this testing of an executive branch versus a legislative branch and a judicial branch.
Thank you for the introduction and the low-pressure question. How do we think about these unprecedented times? We keep an open mind and we check our priors because we've never been here before.
We've never been here before, so how do you check your priors?
It's really important to constantly test your expectations, your confirmation bias,
Right.
to seek a wide range of opinions, which is why I love working with Ebrahim, because he keeps me intellectually honest.
Well, this is great. Thank you for selling Ebrahim to us. I'm going to cut to the chase. The dollar is the prior. Is the great shock of what is to come with this Trump 2 administration a fragility or super strength to the U.S. dollar?
I think eventually it'll be a fragility, actually, and we've got a first taste of that over the last couple of weeks. So in the currency world, I actually think it points to that handing over to the yen as maybe the place to hide in difficult times. But as I said, and as Tina mentioned, many moving parts. So I keep it with Chair Powell, who we'll hear from later today. Be humble and nimble. Check your priors and try to work out what are the preferences and what are the constraints of policymakers along the way.
A question for both of you. I'll start with you first, Ebrahim, and that is during the campaign we heard a lot from Scott Bessent, among others, about the prospects of there being a shadow Fed chair who kind of telegraph what the next Fed chair would think or do, and I guess we're getting a taste of that this morning from the president. He's opining on X and Truth Social about these inflation numbers. Biden inflation up, he tweeted this morning. He suggested that interest rates should be lower before this testimony that you just mentioned. Perhaps he is the shadow Fed chair that was so teased during the campaign trail. But in terms of what's unprecedented, I go back to a question I asked Tom a few minutes ago, and that is, how much more difficult does it get for Jerome Powell to weather the commentary, the critique, the criticism, the politics of this moment? He's indicated over and over again that he's up for it, but this is going to become increasingly difficult for him.
So from my vantage point, it actually is getting significantly more difficult. Yeah. And we've seen that in Jay Powell in his last few press conferences. And he used to be very effective in communicating, and he's become much less effective. And clearly the new administration is a big reason. But I also think it's because he holds a lot less effective sway over his committee. The committee seems to be a lot more politicized. There's a lot of talk about Powell being politicized, but I actually think it's other people in the committee, and on both sides. So you see some unnamed governors being significantly more dovish, and some people speculate if they're aiming to be his successor. But maybe more relevantly, there are a number of people who have tilted from being very dovish to much less dovish when we have had very little data to speak of so far. So I think it's a much more difficult environment. He's much less effective as a leader. Some people will speak of lame duck risk.
Tina, to that point, I mean, he's dealing with the same uncertainty that we are. He's going to field as many questions today as yesterday, perhaps more just about the tariffs policy, how that might affect the economy. He's going to try to bat that down, but there's going to be increasing demand for him to indicate how he's thinking through these issues.
There's a lot of pressure for anybody in a leadership role to both demonstrate their integrity, but also not be perceived as sending the wrong signal to this administration. I think it's important that we don't normalize this, however, because what we are talking about as we think about lower trust in institutions, that includes the Fed, that includes the courts, Congress was always low on that list.
Very true.
And for investors, that means that the non-linearities that are present in the system make it a lot harder to do what market participants like to do, which is say signal versus noise.
In our studios, we are thrilled to bring you this hour Ebrahim Rahbari and Tina Fordham of Fordham Global Foresight. I can't say enough. Usually in London, and to have them in our studios,
treat. Yes.
It is really, really a treat. Can I do an audible?
Yeah.
You are the one I want to talk to on this, in that we have a president going through a routine visit with the Hashemite king of Jordan, Abdullah II. Folks, it takes you back to the movie Lawrence of Arabia. The ignorance of America of where Jordan fits in to the matrix of the Levant is there's no measurement of how dumb I am and everybody else. I had a very well-reported interview with El-Sisi at Davos years ago. El-Sisi of Egypt said, "Enough, I'm not even going." Explain to Republicans now in support of Trump the delicacies of how the president is treating Jordan, Egypt, and the rest of the broader Middle East.
Well, it's consistent with a kind of an American approach to the world, which is get them in a room, knock heads, and make a deal. And so Trump's logic is very, very appealing. But other countries have politics too. King Abdullah of Jordan has 50% of his population is Palestinian. He can't simply roll over and expect to stay in power, and his presence in the region is very important for stability.
And he's been holistic for America from his time at Eaglebrook and Deerfield years ago in western Massachusetts. I mean, this is a guy that's always been on the American team. Is he the buffer to Iran? I mean, on the map, it tells me that Jordan is the buffer to Persia. Am I right on that?
I think Syria as a wild card and the kind of power vacuum there may be more relevant for Iran, which finds itself in a weak position. And what we don't know is what kind of discussion Netanyahu of Israel is having with the president and this move toward maximum pressure and what that means. Because making it harder for Abdullah to sit on that throne, pressuring Sisi in Egypt, could cause what us political scientists call unintended consequences and make a difficult situation worse.
We're sitting here, Ibrahim's going, "Tom, don't ask me about the Egyptian pound. Please, don't. David, save us, please."
Abraham, just bearing in mind what we were talking about a moment ago, that there is so much here that's unprecedented and not normal, how useful is it for you to go back and look at the first term to sort of divine what might be happening here? Is this Trump 2.0? Is it a revision of the manual that we had that first time around, or is it simply a very different guidebook?
I think it's still very useful.
Yeah.
And in fact, the way to approach it is to think about what is similar to the first term and what is different. And I've continued to highlight that there are big macroeconomic differences. We're now in a world where the economy is robust, stock markets are at all-time highs, and inflation is a major concern. So that shapes how this administration will respond. It doesn't need to stimulate the economy. It will worry about inflation, and net, that means it'll be less fiscally expansionary than many people would have thought. But we've had a number of developments that are very much in line with how this administration worked the first time around. And I think the most relevant of them is it loves to experiment, it loves to take risks, it loves to send trial balloons, and it's very keen to reverse course. It likes to act first, see what the response is, and then adjudicate. In addition to that, it likes to, as Tina likes to call it, flood the zone, distract and maybe divide potential opposition.
Confuse.
So there's a number of, and confuse. So there's a number of lessons in the first term that I think investors and the general public would be, in a good position to heed.
Tina, we're seeing that now. There's this big confab that's going to happen in Munich in the coming days, the Munich Security Conference, and the vice president has gone from Paris to there. He'll speak there. I look at the Bloomberg and see a headline this morning. Ukraine NATO membership is not a realistic goal, according to Pete Hegseth, the new defense secretary. From where you sit, What is the next chapter of that
conflict?
conflict?
Steam just came out of her ears. I saw that.
I mean, Ukraine joining NATO, I don't think has been a realistic goal. But Ukraine, with having a European perspective, as the EU likes to say, is a realistic goal. And that is an anchor for the European Union. I think, the military strategists like to quote the old saying that no plan survives first contact with the enemy. When Vice President Vance gets to Munich, he'll get an earful and be confronted with the European reality because Russia's on our doorstep. We've got several NATO member states that are very concerned. This isn't just about creating a demilitarized zone in the occupied territories. If it were that simple, land for peace, it would already have been done.
What is your counsel to someone like me, someone listening who watched what unfolded yesterday in the Oval Office, Donald Trump talking about Gaza as a place that's not worth anything, it's his to buy, indicating there's been no thought into sort of where people there would go if this essentially ethnic cleansing were to happen, people were to be moved out. Not thinking through all of these steps, how much weight do you give to what seem like not thought out, perhaps offhand comments like that versus a broader kind of strategic bent when it comes to the Middle East or other places around the world?
Well, first of all, I think he's serious.
You think he is?
I think he is a real estate developer. He made similar comments about North Korea, right? About
that Pyongyang
all this,
could be the next
Riviera. He sees, waterfront, oceanfront
How
property.
will Mr. Putin respond to that?
Mr. Putin, President Putin can watch and wait, just like President Xi, right?
Right.
Remember we talked about this during COVID, they thought America was in decline, and they're just watching to see the chaos ensue.
Can't say enough about Angela Stent with her. She was on fire. Her book, Putin's World, she was really forceful about we underestimate Putin at this Trump moment. Ebrahim Rahbari, Tina Fordham with his Fordham Global Foresight, a generous amount of time, and we're going to continue. We welcome all of you across the nation and worldwide on YouTube. Subscribe to Bloomberg Podcast. I can tell you this is what the show's about. Catherine Mann nailed it. She went to the bank. She got sick of you guys. She got sick of U.S. Citigroup. Said, see ya. And Catherine Mann, who folks came up with the whole dysfunction of China, U.S., etc. Dr. Mann went to the Bank of England, and she has been a resilient, cautious hawk there. Is that the new tone, Ebrahim Rahbari? Is even with this inflation report, even the middle ground, or dare I say the doves, tilt hawkish over the next year?
Well, I think what everybody really appreciates about Catherine is, again, that she has an open mind, but at the same time, she is a very structured thinker. And what was catching my eye recently with her is she was an ardent hawk on the Bank of England's MPC for the last, probably 2 years. She was on the dovish end of the spectrum when I worked with her. And then in the very last meeting, she seemed to flip back again and highlighted that there are some points of pressure in the UK economy that, in fact, pulled her into the idea that maybe they should be cut by 50 basis points, when previously she was in the rear guard that suggested that the Bank of England should be very, very cautious. Now, the lesson in there for me is for somebody like her, who is not an internal MPC member at the Bank of England. Historically, they've been treated with a bit of a discount by markets because they're seen as less influential. I would say pay a lot more attention to her than you normally would, because it's times of great uncertainty. It's times when people don't really have much of an anchor, where these people have more influence.
I got to get this final question in honor of Willem Bouter, who invented modern Citigroup research. The debt and the deficit is tangible. Americans love to ignore the debt and the deficit. Ebrahim Rahbari, is this a time where we need to focus on the debt, the deficit, and our interest expense?
I think yes and yes, for two reasons. I think one is, the near-term one. This administration has actually focused on it. And again, I think people have been missing how focused they are on, to some degree, managing what they see as a vulnerability in terms of the level of debt and deficit and how much power they have. I mean, the standard answer you get from anybody on U.S. fiscal is, well, the executive can't really do very much. It's Congress's job. Congress is so dysfunctional and divided. We are seeing them taking action. They're trying to cut spending. They have a lot more power over Congress than previous administrations have had. So there's, I think, interesting fiscal action going on right now, which is different from what people expect. There's the bigger question that a lot more people ask about, which is, when are we entering the period of fiscal crisis in the U.S.? And there, I think, massive topic to watch, but that timing, if anything, is actually slightly pushed back relative to what we thought a couple of months ago than what people were expecting.
We're out of time. This has been
We'll have many
wonderful.
occasions to talk,
Can we
though,
make
if
this
past
like
is prologue
anytime
here.
you're in town?
Yes, but I don't have to be in town. But yes, I will be coming more often.
Okay,
We've
wonderful.
got the German elections.
Can
We've
you
got
do
the
something
tariffs.
about London hotel prices?
I'd like to speak to you about New York hotel prices with my weak sterling.
It's unbelievable.
It's harder. It's harder than ever. But it's wonderful to have these conversations, and I think the appetite for this kind of open-minded, checking your priors, it has to be the way forward. We haven't seen this movie before.
No, we haven't, and we're working on it. David and I are reading as much as we can to stay up on this. Stephen Levinsky and the new Foreign Affairs, and Jason Furman, and of course, Tina Fordham writing every day. Tina Fordham, Ebrahim Rahbari, thank you so much for joining Bloomberg today. Futures negative 66, up a stick here, 17.03. Rahbari says, quote, the 10-year, okay. The 10-year real yield for Ebrahim Rahbari, wow, 2.14%, up 8 basis points. We're on YouTube. It's our new digital experience. Subscribe at Bloomberg Podcasts. Bloomberg Surveillance. We say good morning to all of you on a market
This
check.
is
Futures.
Bloomberg Surveillance with Tom Keene and Paul Sweeney on Bloomberg Radio.
There it is. I got out in front. That was my fault. The control room has not made a mistake since their bet on the Kansas City Chiefs for the Super Bowl. But what I can say is good morning to all of you. Futures in negative 60. the VIX 16.81. It's in the yield space. David Gura pointing out yields really move here. 11 basis points, 0.11 percentage points, out to a 464. You wonder, David, I mean, do we get a 30-year bond of 483? Do we begin to see mortgage rates go back above 7% in the 30-year mortgage?
I do think that it kind of puts the comments that we'll hear from the Fed chair in a more interesting prism. And that starts around 10 o'clock when he sits before the House Financial Services Committee, and French Hill, with whom we spoke a little bit earlier, presiding over that now as the chairman.
We say good morning to all of you as we had Gina Martin. What a list of guests today. Liz Ann Sonders with us and Gina Martin Adams. A special moment with Fordham Global Foresight. And now we go even better with Ira Jersey, Chief U.S. Interest Rate Strategist at Bloomberg Intelligence and in charge of our metal concert in July in Northern England as well. Hugely anticipated. Lisa Mateo going over to see Pantera in Berlin over the weekend. Is
she back yet?
She's back. Okay. She took the Gulfstream, but it was because of Ira that she went over to see Pantera.
I see. That was the recommendation.
Ira, did you see this coming?
No, I mean, certainly not to the extent. I mean, it's not a huge surprise that it was a little bit higher. There was, in some of the data, digging into the details, there were some people that seemed to want to get in front of tariffs in terms of buying some goods. Used cars and trucks was an upside surprise, I think, to many. But no, I mean, very few obviously had thought that we were going to get such a strong inflation print for this month.
Jason Furman publishing moments ago at Harvard his inflation report on core CPI, 1 month, 5.2%, 3 months, 3.6%, 6 month annualized, 3.4%, 1 year analyzed, 12 months, 3.3%. David, I'm sorry, stunning is the correct word.
Stunning is the correct word. I'll do a variation on a theme here, Ira, and use a question that I lobbed at David Kelly a moment ago. That is, how did our understanding of the inflation picture change with the data that we got this morning?
Yeah, I think it changed insofar as that it's clear that inflation might be much stickier than everyone was hoping, and certainly than the Fed was hoping. And it's one of the reasons now why the market is selling off, and you see that belly of the yield curve. So the 3-year, the 5-year, the 7-year, all up about 11 basis points the last time I checked about 30 seconds ago. And what that's telling you is that the market thinks that maybe the Federal Reserve's next move might not just be to stay on hold, but might actually be to increase interest rates, so actually hike interest rates. And if we have a string of data such as this, then certainly that there's a real possibility that sometime in early 26 or maybe even the end of this year, the Fed could reverse course and take back some of the cuts that it made over the last 6 months.
Our Saleha Mosen asking Scott Bessent, the Treasury Secretary, about his interest in what the Fed is doing. He quickly pivots to talk about the 10-year yield. That's what he's most concerned about. Is there a divide between the two? How much interrelationship is there between the rates, what the Fed is doing here, and the 10-year yield, Ira?
Yeah, well, it's very strong, and I disagree with one of the comments that Jay Powell made yesterday. The first and foremost, the 10-year is going to be reliant on what the expectation for where the federal funds rate is going to go, and that's kind of factor one, and then factors 2, 3, 4, and 5 are all the other things that, like Scott Bessent can control, which is supply and how do you create demand. It's going to be expectations for inflation. All of those things are kind of secondary to what the Fed's going to do.
How does Ira Jersey control the fear of a government shutdown the middle of March? I mean, I'm not saying I'm predicting it, but I got too many smart people, Ira Jersey, saying within the executive legislative originality that we have, the middle of March is awfully important to the bond market.
Well, so the government closing actually hasn't affected Treasury securities very often. What does affect Treasury securities is the debt limit and the idea that we might actually default on our debt. And that's something that we don't really have to worry about till, maybe June, but it's more likely late August, late July and early August, according to our estimates. A government shutdown, it has a slight effect in the economy. It obviously affects people's lives when they aren't getting paychecks and stuff if you're a government employee. But from a Treasury market perspective, at best it's worth a couple of basis points one way or the other. And if it's something that gets deficits down going forward, then that is something that incrementally could cause interest rates to go a little bit lower than they would be otherwise.
Ira Jersey is going to stay with us here as we continue. He's with Bloomberg Intelligence. David Gura and Tom Keene, good morning to all of you across the nation. On a particularly good morning on the West Coast as you wake up out there. I can do the math, David. 9, 8, 7, 6:29 a.m.
He has his fingers up.
Nailed
He's counting
it.
down
To
for
this
those
day,
not able to
I
watch on
can't.
YouTube.
To this day, I can't do LA time in my head. I have to every time calculate it like that. I'm useless. Ira Jersey's not useless, and he'll continue with us here. An important set of inflation data with yields moving higher. We do need to get this market open. We stagger as we can to John Tucker. Good morning, John.
All right, the opening bell report being brought to you by IBKR. Will the percentage of the U.S. experiencing drought conditions exceed 18% on February 18th of this year at IBKR? Forecast trader, the yes was recently at 35%. What's your take? Trade your prediction at ibkr.com/forecast. There you have it, the opening bell at the New York Stock Exchange. And out of the gate, stocks are lower. The S&P 500 down about 1%, 56 points lower at 6,011. The Dow Jones Industrial Average 352 points lower. That is down 0.8%. The NASDAQ 100 1% lower, down 224 points. The hot inflation data, when coupled with tariff inflation concerns, may keep the Fed on hold. That's the big concern right now. The 2-year yield, 7 basis points higher, 4.35. The 10-year yield up about 10 basis points, 4.63. And some of the shares on the move, CVS after their earnings, 10% higher. Biogen down about 2%. And Lyft shares right now, 15.5% lower. And we check the markets for you. That is your opening bell report. David and Tom.
John Tucker, thank you so much. We continue with Ira Jersey here on Fixed Income. Ira, frame how you will write with your team about a volatile real yield, the 10-year from a 2.20. We had 2 cups of sank at 1.99. We're back up mid-tendency, 2.13%. Discuss the 10-year real yield.
Yeah, so real yields tend to have 2 main components when we decompose them. And number one is the growth rate of the United States, right? So where is real growth? And real growth seems to be pretty good, right? One of the reasons why we rallied from 2.25% all the way down to 1.5% on 10-year TIPS yields, and we call that the real yield because that's the yield that you receive after inflation, is that growth has been robust. You know, you go back to last August, September, and there was big fear that we were heading toward a pretty big slowdown, if not a recession, and clearly that's off the table, and that's where real yields are reflecting. The second big thing, and I think this is one of the reasons why we're up, you know, I haven't checked in the last couple of minutes, but we're up 5, 6, 7 basis points on the 10-year real yield, is because of volatility. So real yields are highly sensitive to how volatile the market overall is, and when I say the market, I mean the Treasury market. When the Treasury market volatility is high, you demand more compensation from your real yield, and that's, I think, one of the big things that's driving the market today, as opposed to just inflation and inflation expectations. So that whole move, that 10 basis point move in 10-year Treasuries, is about half real yield, half inflation expectations, and volatility, I think, is really what's driving that.
Tom Keene piling into tips before the show this morning, worried about what might happen. Your counsel, Ira, was that a good move? Are tips a good, effective way to deal with the kind of inflation spikes that we've seen?
So it's funny you mention that, because I happened to publish a note this morning just about the risks of using tips as an inflation hedge. Tips, if you buy them, will hedge inflation if you hold them to maturity. I think what a lot of people miss is that as an inflation hedge, they're not great, because the real yield move and the price change based on what happens to the real yield move could actually overwhelm any inflation compensation you receive. So be very cautious if you're going to buy an ETF or going to think about holding a tip for a couple of weeks, because it's not a true inflation hedge. They'll outperform. When inflation spikes, tips will do better than nominal everyday treasuries, but they can still have a negative return even if inflation spikes pretty aggressively.
So Ira, when the Los Angeles Dodgers, they have a guy named Mookie, when the Dodgers play the Red Sox, they let the guard down because it's such an easy team to beat. This weekend, when Aston Villa plays Ipswich Town FC, is it the same thing where Aston Villa goes asleep because they think it's a layup win?
God, I hope it's not a trap game. That's exactly what you just described. So Ipswich is at the bottom of the table. Actually, I have an acquaintance of mine actually is a partial owner of Ipswich Town, so I was kind of rooting for them to stay up. But certainly this weekend, I'm hoping for 3 points for my Villa before they start their campaign in the Champions League. And by the way, they beat Spurs, so one of your favorite matches, right? We beat Spurs this weekend.
These are the tots, I was told.
Didn't our people tell him not to bring up the tots?
They're not the tots.
They're not the tots.
Ira, they humbled Tottenham. Humbled. I mean, it was,
Tottenham got a good goal at the end to make it a little bit of a squeaky bum moment where everyone's writhing in their seats because of the 2-1 scoreline. So.
Ira, see you after the 4th of July. Thank you. Bloomberg Surveillance. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. All 11 major industry groups in the S&P 500 are down. Treasury yields pushing higher, and a CPI report showed underlying inflation rising by the most since March, reducing chances of the Federal Reserve rate cut anytime soon. The dollar, that is climbing against the major counterparts. Some are now predicting no rate cuts in the first half of this year. Others seeing a possible rate hike if inflation continues to rise. And, of course, Jerome Powell is going to continue to testify before Congress today. All ears on his reaction to this inflation report. In the market right now, super microcomputer most active, up 6.5%. That is jumping after a bullish forecast. You have Intel up 1.2%, and shares of NVIDIA right now down 1.1%. Lift after its earnings report, down close to 9%. Overall, the S&P 500 down 50 points, a decline of 0.8%. The Dow Jones Industrial Average, 466 points lower, down 1%. The NASDAQ 100 is down 164 points. That is a decline right now of 0.75%. Two-year yield, 7 basis points higher, 435 there. The 10-year is up 10 basis points, and that is at 463. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. David and Tom.
John Tucker, thanks so much. David Gura and Tom Keene. It's a joy. We've got Kevin Hassett coming up with Matthew Miller and company here on the Shock Inflation Report. But first, we continue strong in this 9 o'clock hour. David Gura with Henrietta Trey's.
Henrietta Trey's of Veda Partners, great to speak with you once again. And we had a spirited conversation a few minutes ago with French Hill, the chairman of the House Financial Services Committee, talked about Jay Powell's testimony and also just the prospects of there being some sort of funding agreement here in the coming weeks as that deadline ticks nearer. He characterized himself, I think, as cautiously optimistic, Tom. Henrietta, how optimistic are you that Republicans are going to be able to unify behind a bill that will get this done?
Well, all due respect to Congressman Hill, I am not optimistic at all. I'm at 85% odds that we go the Senate route, which is the two-bill solution, get the president some immigration money, some military investment money, and some energy permitting reform, and then wait until the end of the year to write this tax bill that's going to be massively deficit increasing and very difficult to move through a very small conference in the House. Indeed, if anything, my odds are rising that Republicans will have to negotiate with Democrats on a year-end tax bill. I stand at about 30% there.
Henrietta, dice for us the Republican cliques. It sounds like a Russian movie. The Republican cliques on the Hill. To get to the middle of March, there's the president, and I guess he's doing very visible. There's a speaker who I don't really understand which clique he's in. There's hardcore Southern budget hawks. That's a click. Identify the importance, the weighting, the Trey's weighting of those GOP clicks.
What a fantastic question. Well, you have 18 House Freedom Caucus members who prefer the two-bill solution and $4 trillion worth of hikes to the debt ceiling, along with $2.5 trillion worth of deficit reduction. So that's a bill that cannot pass Congress. And those are 18 members. And then you have another 150 to 180 members of the Republican Study Committee who also support the two-bill option. And that, if you do the math, is about 200 members of Speaker Johnson's 220-person conference. So on a very small island, you have the most important people in the room: Speaker Johnson, Ways and Means Committee Chairman Smith, House Budget Committee Chairman Arrington. These are the folks who want one big bill because they're doing the math and they're counting the numbers to try to get to a partisan bill, and they cannot add it up with the Freedom Conference, the Freedom Caucus, or the House Republicans.
Yeah, the math doesn't work, and the Democrats aren't going to come to the rescue. David Gura, the snapping you hear. I just got a pro tip from Mrs. Keene.
Yeah.
She says at spring training, the older players keep their jacket closed to lose weight.
Oh, I see.
That's
Tough with
why
the bow tie.
She
I've noted
goes,
as
close
well.
the jacket up to slim down. That's what I'm doing here. Continue with Henrietta Trey's.
Our apologies to Henrietta Trey's for that sartorial interjection there from Tom Keene. One thing else that came up when French Hill was speaking was a sense of some irritation, if I may say so, with this whole funding conversation and the liberties the executive branch is taking to try to wrest that purse, that power of the purse, away from Congress. Is he in a small minority there, or do you sense there is increasing outrage with the, I guess you could call it overreach on the executive branch's part when it comes to government funding?
No, I think he's actually in really good company. Senator Rand Paul, who was the chair of the committee that oversaw the Russ Vought, the OMB director's nomination hearing, went out of his way to stress, in conjunction with the Democrat on the panel, that they do not like the president's decision or attempts to subvert their authority over the power of the purse. This is something they take very seriously. And I think one of the compounding factors associated with today's inflation report is that they are saying very seriously, if we want to find deficit reduction numbers, you need to go through us. We need to be the ones that are finding this revenue. You can't come out here and tell me that DOGE is identifying billions of dollars and not give me hard and fast numbers.
Right.
I don't want you going in and cutting stuff that we just appropriated. This is pork barrel spending. This is where they get their bread and butter. This is how they get reelected. This poses real problems for them back home.
Bloomberg surveillance across Henrietta Trey's America. She will continue with this year with Veda Partners. We're waiting on Kevin Hassett of the Trump administration, the NEC director, to give us wisdom on this inflation report. Henrietta Trey's, which Republicans in the white marble of Capitol Hill are you watching to see when they say to the executive branch, enough of taking over legislative prerogatives? Which names are you watching?
Well, I will shift this just slightly. There are three folks on the House Budget Committee that I'm watching most closely because in order to give the president what he wants and to deliver any kind of legislative victory that will allow them to sort of take back this power, you're going to have to get a budget resolution through these three members. And that's Chip Roy, Ralph Norman, Beechin. These are the members whose votes are essential just to unlock the ability to write that bill. And those are the three holdups right now on the House side. On the Senate side, everybody's watching CPI Day, and that's all very exciting. But the Senate Budget Committee starts their reconciliation or budget resolution hearing today in about 10 minutes. And I will be all eyes glued on that. And Lindsey
Right.
Graham.
What's Jody Arrington going to do? I mean, the tennis player from Texas Tech. The guy, he was a walk-on. Texas Tech football.
Yeah.
And was famous in tennis in Texas. What does Chairman Arrington do, who's a budget hawk?
Well, he's trying to thread the needle between Speaker Johnson, who's saying we're going to find $1.5 trillion in offsets to this $5 trillion tax bill, and then the House conservatives that I just mentioned, those three guys that are also on his committee, who want $2.5 trillion in deficit reduction, which really equates to about $1 trillion in deficit reduction on top of a $1.5 trillion spending component. So there's a lot there that he needs to thread the needle, and that's why I'm so pessimistic that the House moves forward first. Their numbers do not add up. The Senate's path, which is a $340 billion spending package, is a lot easier to get through. That'll be what we do for the first half of this year, and we'll come to fight the tax bill in the second half and it'll pass in late December is my expectation.
We have an array of screens in front of us here in the Bloomberg studios.
Yeah,
and
it's good. I mean, let me see now. Yeah, it's 9:45, pitches and catches. Look at the screen we've got at spring training is good.
That feed has gone down a little bit. But in the moment we have left, Henrietta Trace, I see Pam Bondi, the Attorney General, speaking on the White House lawn. And there is something novel about many facets of this administration. But seeing these figures who customarily don't have that kind of public-facing role under the aegis of the executive branch tend to be speaking out a lot more. Could you just speak to the rarity of the moment that we're in?
Yeah, I think that the press briefing that took place in the Oval Office was another really good example of that. You had President Trump sort of quiet the entire time, sitting behind the Resolute desk, when Elon Musk and his son were really taking over the commentary and walking through what Doge is doing. I've never seen anything like that. It was really quite the press conference where you're giving an inordinate amount of time to these figures who have a lot of sort of name brand attention, whether it's Pam Bondi, Tulsi Gabbard, RFK Jr., or Elon Musk, and they are these very outspoken characters in this play of the 2025 presidential cycle and the Trump administration.
You got to come back, Henrietta Trace. Thank you so much. I want to talk to you about Jack Bergman of Michigan next time you come back. Henrietta Trace, encyclopedic on what goes on in Washington, hugely valuable with Veda Partners. David Gura and Tom Keene are usually it's Jobs Day, and you get the NEC director of the Department of Labor, but today it is an inflation report. The gentleman with parchment from the University of Pennsylvania, Kevin Hassett, a Republican economist for years now, with our Matthew Miller.
Welcome our Bloomberg TV and radio audiences. We're going to get together here because underlying U.S. inflation last month rose by the most since March. Here to discuss the latest inflation read is Kevin Hassett, National Economic Council Director. Kevin, great to have you on. You know, I am a Reagan guy. He was the first president that really caught my eye. And then I grew up reading you and when you were at the AEI, when you were writing columns for Bloomberg. So supply side economics is something that I get. But I've heard you mention a couple of times on a competing network the possibility of reducing aggregate demand in order to keep inflation down. And I'm wondering if that just means cutting government spending a la Doge, or are you really willing to slow down U.S. economic growth in order to hold prices level?
No, we're absolutely not willing to slow down economic growth, and we will not. In fact, President Trump is telling everybody that we're going to have a golden age, and we're hatching a plan to do that. But the bottom line is that, as you know, you just talked about the CPI, that the economy that we inherited from President Biden keeps looking worse and worse. So that their jobs record was revised down by 1 million jobs just a week ago. And now we're seeing that core inflation and top line inflation are really, really above the Fed's target in the latest report, which is really the last report for the Biden administration. The Trump administration has a really aggressive plan to fix the disaster that the Biden economy became. And in fact, if we go back and look, that right now it's the case that Americans are still paying something like $1,200 a month less or more for the same amount of stuff because of this inflation. And egg prices are up 100% in the Biden administration and so on. So there's a lot of work to do. But the way you get inflation down is you do micro things. And we can talk about those micro policies, like how do we address the avian flu? We're all over it. But then you do macro things, too. And the macro things are to get aggregate demand, all that massive government spending, $1.5 trillion a year more than we thought it would be this year, back when we looked ahead in 2019. So you got to get that spending down, and then you got to have more supply side policies like deregulation, drilling, and tax cuts.
Well, let's talk a bit more about inflation and how you plan to address it, because a lot of people looking at these numbers are saying this doesn't even factor in the impact of tariffs here, tariffs that have just been put in place, but also potential tariffs to come. So how do you plan the administration to actually lower prices if these tariff policies come through?
Again, in the end, inflation is very much a macroeconomic phenomenon, and it depends on balancing supply and demand. And you guys might recall that when the big runaway stimulus bill that the Democrats passed was first passed, that even before inflation began, my friend John Cochran and I out at Hoover wrote an article at National Review, and we were talking on TV about how this is probably going to be about 7% inflation that year. And so it's not rocket science. It's not really hard to calculate what happens. What you have to do is have a lot of supply and reduce demand. And if you do that, prices go down. And so a big positive supply shock with more constrained government spending is going to fix the problem. But meanwhile, we're not just waiting for the macroeconomy to turn. We're also going after the micro issues one by one by increasing energy supply, reducing regulations that are very costly, and even going after, again, very targeted things like what are we going to do about the fact that Joe Biden last year killed 130 million chickens, and that's why egg prices are so high. We're putting together a plan to manage the avian flu in a much wiser way. And so we've got an all of the above approach on inflation. And so this bad number, just remember, is closing the books on what Biden has done, which is allow inflation to get out of control. And the Biden people that he chose are also complicit in this. You might have looked that Austin Goolsbee, the Chicago Fed president, just gave a speech a couple days ago saying, hey, inflation's under control. And here we see that we're looking at a 3-month moving average above 4, right? So that's not what the Fed should be saying right now. And it's not true, but we're going to fix it, with or without the Fed, because we understand macroeconomics.
You do have the president talking about wanting lower rates, but when you do have inflation as it stands well above the Fed's target persistently, and an increase in many aspects of the American economy as well, how would you then lower rates into this environment? Wouldn't that be considered imprudent given where inflation stands today?
It goes back to actually proving what we were just talking about. If you go back and look at what's happened to the 10-year yield since Treasury Secretary has been there, since Doge has started to make real progress cutting spending, then we've gone down, we went up, we're up 11 today on the bad inflation news, which is backward-looking, a Biden failure, but we're still many, many basis points ahead over the last week and a half, where there's all this positive spending news. And so I think that, instead of 409, we're at 464 looking at your screen. And all that progress is the early first few week progress of these policies that we're talking about. And so interest rates can come down if you have prudent macroeconomic policies, and we're doing it. And it's already reflected in Treasury markets.
Well, it doesn't look like Powell is going to be lowering interest rates. I mean, how can they if inflation is reaccelerating like this? It won't be at the short end, will it, Kevin?
Right now, I think that all economists have, after lots of study, agreed that it's the sort of 5-year to 10-year rate that has the biggest effect on the economy. And that going down is a big positive for growth that's non-inflationary. And so to see 10-year coming down the way it has after we've announced our policies is exactly what markets should expect. And as you see the budget deals happen, I've had lots of positive conversations with members of the House. I'm going up to meet with the Speaker today. I think, actually, I haven't looked at the afternoon schedule yet. And we were, we're talking to Lindsey Graham yesterday. It looks like budget deals are really moving forward. When all that positive news starts to influence markets, then they'll respond favorably, is my expectation, and interest rates will come down, because instead of spending $1.5 trillion a year more than we thought we'd be spending back in 2019 when we looked ahead to this year, we're going to be spending a lot less. And one of the interesting things is that we're finding all of this wasteful spending through Doge that nobody else in the Biden administration was looking at. And they were just spending money willy-nilly, throwing money out the window without even telling us what they're spending it on, we find. And now we're shutting that down, and Treasury markets are responding already positively and doing what President Trump wants, which is to get interest rates down so that we can have a stronger economy.
Yeah, 10-year yield's currently higher by about 11 basis points on the day. One day doesn't make a trend. But Kevin, I want to go back to what you said, that you're going to fix inflation with or without the Fed. Of course, we've talked about lowering interest rates, but you have a vocal chorus out there saying that actually the Fed should raise interest rates. Mohamed El-Erian, one of them, saying that if the Fed believes in 2% inflation, they should hike rates. That should be their next move. Wouldn't working with the Fed here mean that you should be calling for higher interest rates?
Look, a lot of the people that were appointed by Joe Biden who are running the Fed have made a lot of mistakes on inflation over the last few years, starting with letting it get out of control by saying, oh, it's all just supply disruptions and so on. And then after they failed, then they put out studies saying, oh, it was all supply disruptions in order to cover their tracks. And so those same people are acting now. And one of the things we've seen is that the Democrats that are appointed to the Fed are willing to be partisan. And so you could go back and look, but the Fed, for example, after Donald Trump the last time was elected and before he was inaugurated, they raised rates. They raised rates, even though inflation was in the ones. And so the Fed's going to do what the Fed's going to do. But if we have really strong macroeconomic policy, if we have supply side policies that increase supply and reduce aggregate demand because we're getting rid of wasteful spending, then inflation's going to go down.
Kevin Hassett, the NEC director here, defending the nascent economics of the Trump administration. And David Gura and I agree that a good way to start, foreign affairs is on a fire this month, with people looking at our politics and our economics. And Jason Furman leading with that article, really quite harsh about his Democratic Party policy.
And I'm sure we're efforting Dr. Furman, get him on the show sometime soon.
Another
Another piece,
long conversation.
Great conversation. And piece we were reading this morning by Stephen Levitsky and Lucian Wei of Harvard and Toronto, respectively, focusing on kind of the uniqueness of this moment, coming to the conclusion in the pages of Foreign Affairs that America is on the cusp of competitive authoritarianism. And there's some nuance there that I think is important and makes the piece so interesting to read.
And we tried to advance that with a Republican, French Hill, today. We thank him for attending. And with Tina Fordham and Ebrahim Rahbari, they'll be featured on Single Best Idea. We say thank you to all of you. We say special thank you to Liz Ann Sonders, who refused to stay around like Alex Steele, for Nickelback. Good morning.